We're Gucci, yeah? We are Gucci. Been a while since we haven't been, right? Been a while since we haven't been. Got a link for this thing. Open the Discord thingity thing. Boom, boom. Boom, 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 boom. May not be the longest of streams. So I don't know what's going on. I got like one of my stitches are pretty sure it's like infected. Pretty sure it is infected. And I think I have like an ear infection because of this shit or something. Well, I mean, I don't know if it's related per se, but what should we call this? Easy short. Yeah. Yeah, my whole like ear like hurts. I don't know what's going on with that thing. But I mean, in terms of getting caught up, we did end up kind of putting the balance here. But the real thing was a short, right? We kind of talked about shorting this. Like SFP to the highs, like on CME. Also, if you could have taken like the lower time frame, kind of like little failed auction that formed there. God, there's just a lot going on at this level, right? Like we talked about when I went to bed, how there was like a bunch of shorts piling into this move again, with like this zone left to like get finished. And exactly what happened, right? Came back and yeet, 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 yeet. Lots of ways you could have taken this, right? Could have taken the SFP, could have taken the failed auction, could have had limits set with like a fib. I'm unfortunate that we didn't end up reaching the zone up there, because this would have been like, if I was not in a short and gonna take a trade, I mean, I probably would have chased it a bit once I saw like the failed auction kind of forming. But I would have ideally had like limits up here kind of thing. But yeah, either way, juice, right? Either way, some free juice on that. A little easy short, nice juicy scalp. Would have got paid quick too. Just update the levels. And be on our way. On our way. 88237. No, also, you know, let me finish this, then we'll yap. 88232.8. $87799.7. What was it? 87799. I'm near losing my mind. 8596. Yeah, you know, yesterday we were watching some of those videos, right? And we were a little, perhaps overly critical of that Tanja girl, right? But something just, it leaves a bad taste in my mouth when people are talking about trading and they're talking about subjective topics and they speak on it in an objective manner as if it's fact. Because that can be very damaging to someone that doesn't know the better, right? Like someone that's newer to trading and doesn't know what's really going on. Kind of like an appeal to authority. It's like a logical fallacy, essentially. But that's more of like a poor reflection on me than her, right? Like at the end of the day, we should be trying to like elevate people, not bring people down. So we should definitely be more mindful going forwards, and not I should be more mindful going forwards of not being critical in a negative manner, right? It should be like in an informative, positive manner. And also, you know, this morning, out of curiosity, I looked at her stream for a bit, or like one of the previous streams. And pretty helpful to her viewers. Streams for free kind of helps people out constantly. It doesn't have to do that, right? Especially while scalping. It distracts her. Shout out to her. I don't shout out to any trader, right? That's like the real takeaway from that. That is the real takeaway from that. Probably write some of this stuff, yeah. Get rid of this, get rid of this. This box never got finished. Like we tapped it, but get rid of this, get rid of this. So we need to check up on Micron. Also, I don't get why like there's a poor high on the perps, but not the Coinbase contract, right? Even with like all the different tick sizes, a bit odd. Still doing its thing. Boom, 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 boom. Thing is still going. Interesting. What the fuck was that? What's that? I'll turn this alarm off. Also, shout out to the Canadian healthcare system, right? I'm supposed to get an ultrasound for my shoulder because it's been bothering me. The appointment they give me to get my ultrasound is in February. The middle of February. 2 months away just to get the fucking ultrasound. Not even get the diagnosis afterwards of anything potentially wrong or any further follow-up. I find it so funny when people from other countries think that universal healthcare is like this like amazing thing. Actually comedy. Boom, 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 boom.
How you know the bounce like that? Because the fib don't lie. And what if I test that level? Then I'll buy the dip every time. The math is the math, and we don't miss.
Harris Kamal. I know someone that was recommended a brain MRI. The appointment was 1 year later. Yeah, it's very ridiculous. Very ridiculous. It's so stupid. I don't know anyone can take this stuff seriously. Also, in terms of the S&P, by the way, right, we were talking about this stuff yesterday. Like this 3,800 level. Or 6,800. We'll just toss on a TPO real quick for the open. We open right there, right? You try to go through it and she immediately nuked right after. Push out to the options data, right? We're almost down the level. I'm hoping by the time I go, my shoulder is fine. Because with these stitches, I have just been resting it, so... Thoughts on Sessa after all-time high? One sec. I mean, nothing really though, honestly, nothing really. Isn't there some like big trend line or some shit coming in from here? I mean, we'll see. Can it break out, or is it gonna fill the gap and go, or what? I think if all the market just keeps rolling over, I don't think it's gonna... It's more like a trap than anything. It's not particularly high volume either, right? We'll see. We shall see. Boom, 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 boom. No, I'm not planning to sell for a while. So like in terms of like my Tesla position, like I'm trying to hold this until the stock is like, literally like in the thousands of dollars, or probably like a stock split by then. It's like when they approve the pay package, for example, assuming those goals get met, the implications of that, given the numbers that are in that deal, the price of Tesla would have to 7x from where it is now. But I wasn't planning on touching this for a while. But if stuff starts to like really go to shit in the market, then yeah, I might be taking some off. Like, I'm making a huge profit on this, so yeah. In terms of this, the breakout of itself in this exact moment, a little odd. It'd be quite weird for everything to just roll over and then Tesla's like the one stock just pumping, maybe, but. We'll find out pretty soon, right? If it like fills this gap and starts to like go lower, especially if it starts to lose like this level, then like yeah, probably just a big trap, right? But if it does like this or this, probably good to continue. I'm not really giving anything much like weighting of what's going on right now. Like, it's like next week's basically like a write-off. So was the week after. It's options expiry this Friday. And it's the end of the year, so I'm not expecting to see any crazy volume in any of this stuff until like after the new year. Boom.
You're spending, you know, what is it?
Okay. Let's listen to some Bears yap. Yap away. Boom. Actually, let's finish looking at some of this data first before anything. Before anything. Because the other thing about this is like the max pain for like the SPX is like pretty low on Friday. So I'd be surprised if we just start pumping higher from here. Like 6,400, I think it was. Boom, boom.
Tap the line, no guessing. Chart so clean, it's a weapon. You buy hype, I'm testing. You chase green, I'm resting. Pull up, slow, then vanish. Fizz mapped out so lavish. 618, I vanish. You get clapped, I planned it.
Okay. Pause this, switch this.
And OpenAI wants to spend $1.5 trillion building these data centers. And that's for this large brute force, large language model approach. If that's barking up the wrong tree, there's a huge misallocation of capital underfoot. And again, you know, that could lead to a market crash if people have this oh my gosh moment. If you're feeling that you missed silver or you missed gold or you buy the idea, but you don't want to chase them at least nominal all-time highs, if this thing happens in a big way, it creates an opportunity for people to buy at more reasonable prices.
Lobel Tigre is back, fan favorite in the commodity space. He is the independent speculator founder. You check him out on X and also his website down below. Lobel's been sounding the alarm bell for the economy for quite some time. Let's see what he has in store for us in terms of his outlook for 2026. He said something big is happening. He's also correctly called gold and copper and silver to go up. All these metals have performed spectacularly this year. Per Lobel.
Like, is it just me or is OpenAI fucked? Like, am I the only one thinking the same thing here? Like, is it just me or are they actually fucked? Like, if their entire business models like be from like subscription revenue, and Google is just going like free to use, and all like the free open source LLMs out of China and even North America are free to use, a little suspicious. A little sus, we will say.
Calls, so we'll see what he has to say for 2026. Welcome back to the show. Good to see you.
Thank you very much. Uranium has also had a good year, not quite as spectacularly, but that was one of my favorites. But sorry, Dave, I got to push, or maybe not push back, ask. Really, fan favorite? To look at the comments on YouTube, I'm Darth Silver. I'm one of your most stupid, misinformed, wrong-headed, hates everything good in the world. Somebody actually said that. You hate everything good in the world because Silver's not going to the moon tomorrow.
If somebody has this much emotion, let's put it that way, that he has to expend on an internet personality such as yourself, then you've done something right. Maybe something wrong according to some people, but something right. Since you brought up silver, we can start with silver. So we're going to talk about copper, silver, gold, and the economy today. Silver at $63. It was at 68 not too long ago. Last week, I believe, almost at 70. This is a surreal moment to be talking about very casually in a blasé manner tone that you can tell that I have. Oh, it's almost at 70. And this was not a conversation or a sentence that I put together many years ago that I would think I would put together this soon. Did it go up a little bit too far, too soon for you, Lobo? Darth Silver?
Silver Bulls, I should get my Darth Silver mask here, except I'm not going to say that. I'm going to say, actually, no. It has gone up faster than I would have thought right now, because I'm actually a long-term bull on both monetary metals. I think this bull market has years to run. So I don't think we should be in that blow off top. Even the most diehard silver bulls would tell you silver lags at first and then more than catches up at the end, right? We all know that. So if we're in the silver catches up part, that implies we're towards the end of this bull market. And that's not my outlook at all. So to the degree that I had anything negative to say and deserve the Darth moniker this year, it would be that I was unhappy that silver looked like it was catching up. And in fact, if you look at the charts from the bottom, not the peaks. I don't know why everybody likes to look at past peaks, but gains are calculated from bottoms, from troughs to peak. So if you look at the last bottom in 2015, silver has now caught up to gold on a percentage gain basis. If you're a long-term bull, that should be a concern. We don't want silver to catch up yet. We want, years ahead of bull market to run. So yes, I have been saying, be careful what you wish for. I don't want silver to do that, blow off top catch up thing yet. And so it was a concern that it went so high so quickly. But the reasons for that are not because somehow the debasement trade has gone into overdrive or the macro context has monetary metals going vertical. Gold is still sideways. Okay, we've come back up from 4,000 when we last spoke, but we haven't hit a new all-time high, whereas silver has, at least nominally. So it's specific to silver. It's not a monetary metals thing, it's a silver thing. And as many of your guests, I'm sure, have probably told your audience, they don't need me to wax rhapsodic about it. There have been supply issues in London and elsewhere. India's been loading up. So it seems to be, in my view, a silver-specific thing, which means it's probably
it's really not though.
Gonna last forever. I expect silver to consolidate.
Everything except gold is going.
Maybe it goes up. The technical guys tell me it goes up to 68, something like that, just below 70, and then maybe corrects for a while. I don't know. I don't have a horse in that race. But the bottom line here is I'm not bearish because silver is doing that blow off top thing. I don't think we're there yet. I'm bullish because silver's gone up for idiosyncratic reasons. And if it corrects for a while, I think that creates buying opportunities before the next big leg up. So we kind of covered a couple of things here at once, David, but I'm overall, the bottom line is I'm, for reasons that your audience is well aware of, very bullish on both monetary metals, and I'm not concerned about silver outperforming right now. I think that sorts itself out, and then we keep going on the trend that we've been.
We'll come back to the metals in which you think is going to be the best performer in 2026, so stay tuned for that. This is just in today data from this morning. Unemployment rate, the long-awaited delayed unemployment rate in the U.S. up to 4.6%, a 4-year high. And I'll just leave it here. You mentioned to me offline that something big is coming. I'm not saying it has to do with the labor market. I'm just putting data together here. What is this big thing that's coming for 2026?
I think the big thing that's coming is a significant unwind of the AI trade. And whether that's actually the AI bubble popping in a waterfall event in the markets or something a little less harmful, I'm not sure. But it is really striking to me. You put up that chart today. That is the news of the day. But we also had not just the gap in the information from the government shutdown. We also had a bunch of furloughs of government employees that are now back on again. So that could reverse. Like this 4.6 number could be significantly lower next month because those people are back at work again. But we also had today, I thought something really interesting. I don't normally pay attention to, big mainstream names. But I remember I'm blanking on the name. There's a billionaire hedge fund investor on Bloomberg this morning who talked about Mondami and talked about Europe and competitiveness. But the big thing that he said that really struck me was he was not necessarily bearish on AI, but he was basically deflating the hype and saying, look, everybody got all excited about AI, but I'm talking to big businesses and yeah, they're using new technologies. They're modernizing, they're automating, they're upgrading, but they're not using ChatGPT. It's not a large language model that's helping them to reduce payroll, actually. And I thought that was insightful and important. Like I've been chomping at the bit to use one of these models to help me in my research. And it's not just the hallucinations, it's the limitations of what they can do. If I need something to read everything on the internet and summarize it for me, then great. It can do that in a second faster than humans can do. If I need analysis, if I need understanding, I just don't think this is the right technology. And that's basically what the guy was saying. I think and if that's true, and you're spending, what is it? OpenAI wants to spend $1.5 trillion building these data centers.
I mean, I don't know if we can agree with that, right? These things probably do better than the typical average person, and it will only get better and better and better.
Large brute force, large language model approach, if that's barking up the wrong tree, which, by the way, as DeepSeek has suggested repeatedly, right?
And also we're about to in terms of seeing a spike in LLM potential. We're approaching the next spike pretty soon, right? With recursive self-learning. Right now, I was watching. If you watched the Moonshots podcast, they had an episode with basically the CEO of DeepMind, the Google DeepMind. I mean, AlphaGo and whatnot. And he was saying that right now, all these companies like Meta, Facebook, or not Meta and Facebook, Meta, Google, so on, they're all working on that same problem, OpenAI, and they're all basically at the finish line of solving that issue, which is gonna increase the rate of learning a lot because you don't have to do the supervised learning after initial training.
There's a huge misallocation of capital underfoot. And again, that could lead to a market crash if people have this, oh my gosh moment, or it could just be, a slower deflation of this balloon. But either way, the market concentration and the amount of money that's riding on this single thesis makes everything vulnerable to any correction in that space. So I know that we were talking about metals and other things, but you asked what's on my mind. I think this is on my mind. And to connect this to metals, you say, okay, well, serves those guys right for getting all hyped up about AI and all this bubble and everything. Fine. But the problem is that uranium has become an AI play because of the power needed for these data centers. Copper has become an AI play. Even silver. I've seen headlines saying that silver is an AI play.
Yes.
So if this thing unwinds, whether catastrophically or more in a less malevolent way, it becomes a headwind for everything, including hard assets that you and I care about.
I can't I have a hard time seeing a world where there's some massive market crash because of this, right? Sure, people can make a bear case for AI in terms of the speed of development, perhaps, or we're building out more than necessary. But this is not a Ponzi, right? This is this is world-changing technology that's here to stay, long term. Some people might get some short-term fears about some of this stuff, but in the end, a borderline inevitable.
By the way, good for Bitcoin either, which I know you care about more than me.
You already know why people hold gold. It's because it's real money. But we care about Bitcoin on the show as well. So this famed short seller explains why he's doubling down his bet against data centers. I believe this was your one of your tweets from earlier. Jim Chanos, am I saying his last name right? Says his money will come from what the chips produce, not where they reside.
Yes,
The-
that
the-
one made the waves yesterday. This morning's effort was from Ken Griffin from Citadel. And Jim Chanos, he's a short seller, so of course his perspective is considerably gloomier. Griffin was trying very hard to be polite, not offend anybody. He was in Europe, he was in Paris giving this talk, so he didn't want to talk about how Europe is in the shitter or something like that. But basically, he was saying they were really stuck and needed to do something. Draghi gave them a road plan, and they're not making progress on it.
Europe's ridiculous. I saw an infographic the other day, which is fucking mind blowing. Like the European government has made more money from taxing, like fining American tech companies, like how they recently fined like X, than they've made out of tax revenue out of all the tech companies in Europe. that continent is literally a fucking grift, right? There's no wonder no one wants to do anything there.
And on the AI thing, I think he spent more time of that interview on AI than anything else. And he just, he told stories and he talked about meeting, like he's a high-powered CEO himself, and his buddies are all saying it's great. We're using new technology. We're becoming more efficient. But none of them, he said, none of them, not one, is using, in a large language model, whether it's ChatGPT or Claude or Gemini or anything. None of their productivity gains is based on those models. That's a giant red flag.
There are writers out there on the internet that believe that one of the reasons silver went up, and we talked about silver already, but one of the reasons silver went up is because of the AI trade. AI data centers just sent this other metal to a record high. Spoiler alert, this other metal is silver. I won't read the article, but this is what he was talking about.
I did read that article, David, and it doesn't say why. I was annoyed. The people
it just says silver has more industrial uses than gold.
It's an AI play. There's nothing in that article that says how, where do the data centers use it? Now, if you know something about it, you know that silver is used in nuclear fuel rods. So, that's associated with AI. It is used in various electronics, but so are other things. To say that it's specifically somehow an AI metal and not say anything about why, sorry, that really annoyed me. And
sure, I can understand your annoyance. I'm like that too sometimes. But the point is here, if the data center or AI trade unwinds for whatever reason, we have the markets falling because of tech stocks, AI stocks falling in valuations, wouldn't that bring down the entire metals complex, uranium, copper, and silver?
Yes, it shouldn't, but it will. I mean, and this is one of those things. So the bad news, there's bad news and good news, like the doctor tells the patient in the joke, right? The bad news is that to the degree the AI hype has pushed all critical minerals, which includes uranium and silver now officially, not just copper and other oddball metals. And in Trump's mind, he included gold, by the way. In one of his executive orders, he called gold a critical mineral as well. To the degree that any or all of these have gotten a tailwind because of the AI narrative, let's just say, and to the degree that goes into reverse, then that tailwind becomes a headwind. Now, how bad? I don't know. I mean, I can ask my magic 8-ball here and give you an answer, but nobody really knows, David. And I wouldn't believe.
I just got to keep all his random shit by his desk.
So, what to do with this? I'm not being very helpful here, saying I don't know. But I think that's better than saying I do know and then being wrong. So
let me just pin you
that was
to...
the bad news. Let me just wrap up and say the good news is that to the degree that this happens, I think it creates a fantastic buying opportunity. Like if you're feeling that you missed silver or you missed gold or you buy the idea, but you don't want to chase them at least nominal all-time highs, if this thing happens in a big way, it creates an opportunity for people to buy at more reasonable prices. Personally, I think I'm allergic to buying at all-time highs. I'd much rather look for the next big dip. So that's the good news that I was saying from the doctor joke. The good news is that this thing that I'm concerned about could actually create a spectacular money-making opportunity for anybody who's patient and disciplined enough.
Buying, you're allergic to buying at an all-time high. Okay, so I have here a chart of silver, gold, and copper. Year to date, silver's up 120%, gold next at 62%, copper last place at a measly 33%. What are we going to do with that? Now, Lobo, if you were allergic to buying something at all-time highs, you would have missed the rally on gold over the last 2 years, because ever since basically $2,000 and change, it's been at an all-time high.
There. Look at that chart, because I don't want to. Sorry, I don't mean to interrupt. Actually, I do mean to interrupt. But I want you to look at the chart you've got on the screen now. Look at the lines. And yes, we had these big surges in 2000, but then we had years of consolidation and substantial drawdowns.
Yeah.
Sorry, $2,000 for gold 2020, I think I can't see it chart, but I think that's what we're looking at. So that's what I'm saying. I'm not saying wait for gold to go back to what was the previous low, 1300 or 2001. I'm not saying to wait for it to go down to $258 an ounce. I'm saying that if people can't see what I'm pointing at, but that first surge on the left-hand side of your screen there, I wouldn't buy that. But months later, where it's wiggled down, then yes, I would buy that as long as I was still confident in the thesis. And
so would you,
from the beginning of our conversation here, I'm confident in the thesis. I just don't want to buy that spike on the right.
Which of these would you still buy right now, given their moves already?
and you don't
Still?
have it on there, but uranium too. This is exactly the thing for people who are frustrated and saying, look, it's going, and you're just sitting on your hand. No, I'm not. If you want to buy high and hope to sell higher, well, knock yourself out. I was taught to buy low and sell high. So when things, even if I like them, they're high, then I look for something else that isn't. And to go with your chart here, copper has afforded opportunities. There are copper stocks on my shopping list right now for this very reason. You can still find things that are available to buy low. And uranium is even better because the spot price has been highly volatile in the last few months, but the long-term contract price, which is the real uranium market, is actually going up. So if the real market's going up and the spot price has stocks on sale, that my most recent purchases have all been uranium stocks because of that volatility. This is an old Doug Casey thing, my mentor. He used to say, make volatility your friend. That's exactly what I've been doing. And I expect to do that in gold and silver going forward.
Well, what is the copper trade going into 2026 then? If you think AI is overpriced and perhaps on the way to a bubble pop, what's driving copper to higher prices?
Well, first off, it's Dr. Copper, right? It's a fundamental industrial mineral. It's like iron. Like you can't have civilization without it. We can't have modern civilization without copper. Some people like to say copper is the new oil, right? I don't quite agree with that, but I understand the sentiment, and there is a reason for it. So it is absolutely fundamental. And copper was and would go up even without the electric cars and without the AI. It's essential anyway, and the supply is constrained. Even more than uranium, actually. But the kind of mega projects that are needed to continue to fuel the world or supply the world with copper are few and far between, very hard to permit. Even the Trump administration has struggled to get a resolution to a famous copper project in the United States. So sorry, one more quick comparison there for the ones that are on sale.
Why is that?
Relatively on sale. Unlike uranium, there's no nuclear accident that can take copper out and melt our portfolios down, and that can happen in the uranium space. So the lack of that risk makes me, I like both copper and uranium for being.
Is that like a real risk still, like having some like nuclear malfunction at like a facility? Yeah, I thought we were past that. Because I read it, there was like some, I don't know what it was exactly. But there's something that they encase like the reactor with, where like if there is some issue, it's like not a big deal.
Cheaper, but copper is the lowest risk, which goes to the 2026 outlook question of why is copper again my top pick for 2026? It's not because I necessarily think copper will go up more than gold or silver or uranium. It's because I have the highest confidence that it will, and that I think it will be substantial. The supply side is deeply constrained. And by the way, even if the AI bubble unwinds, it's not like there'll be no AI. And like another big news headline today is that Ford's taking a $19 billion write down. I'm sorry, it's not funny. But a $19 billion write down on having gotten a little too enthusiastic on the EVs, and now it's going with hybrids and other things, and gas guzzlers. And the stock is up on that news last I saw, despite the write down. Right. So
we have to, right? Like like trying to make electric cars is killing these ICE manufacturers, literally killing them. So like, they have to go back, at least for now.
Not going away. And by the way, the hybrids, they use a lot more copper and other critical minerals than the regular gas cars. So what I'm saying is the potential headwinds or corrections that we've talked about, they don't torpedo the underlying thesis, not for uranium, not for copper, certainly not for gold and silver, monetary metals. So I don't see those. I don't see that volatility as a negative at all. I see it as a good thing for anybody who's looking to deploy more capital in this space.
There's also the supply side of the story. So let me just read this article here. So copper continues to hit new highs, could hit stratospheric new highs, says the CNBC writer. According to Citi, projected copper deficits due to constrained mine supply and continued hoarding of copper in the U.S. due to arbitrage opportunities are expected to contribute to price surges. We expect the U.S. to hoard global copper inventory and, in the bull case, draw further on depleted ex-U.S. stock. What is this hoarding they're referring to?
Well, if you make anything a critical mineral, then you want to have supply. And we see, not so much in copper, but in other, oddball metals, you see the U.S. military highly active in this space. The antimony and the galliums and things like that. They need that stuff, and they want to make sure they've got it. So we haven't gone so far as to establish a strategic copper reserve, but that's the thinking, and I can see that. But actually, let me go a little bit sideways from this question, David. That may be a factor, but for right now, for this year, I think a far bigger factor is the fact that we've had 4 major accidents or incidents at large copper mines this year. And, mining is a dangerous business. There are fatalities every year. There are accidents every year. Sometimes there's supply taken offline for these reasons. And that's simply the nature of the business. But 2025, we had an unusually large number of them and accidents affecting big mines, Grasberg and Kamoa, Kakula, and some of these really big producers. And you can say, okay, well, that was a 2025 thing. It'll be fine in 2030. No, these things can take years to fix. And prices are determined at the margin. Okay, it's not like copper supply has been, decimated or something. And I mean that literally in the sense of cut 10%. But even 2 or 3% is a big deal if prices are determined at the margin. But what I'm saying is that 2025, I was bullish anyway. But then we got a number of, not predictable events that really weighed on, put their finger on the supply side of the scale, pushing it down. And those are not easily fixed. And who knows how many accidents we'll have next year? There's always some accidents. But the ones we had this year, the companies affected, they're talking about 2026, 2027, 2028, when things might return to normal. So
Interesting.
That's a big deal. And here's the thing: there can be a supply side surprise. It's always negative. There's never a supply side surprise that's positive. Somebody doesn't just unveil a 1 billion ton new mine that they're producing and sending thousands of tons to market on a daily basis. They might make a discovery, but then you got years before the mine is built.
Can you explain to the layman why this phenomenon that you're describing happens to the metals, but it doesn't seem to happen to oil and gas, for example? Whenever there's a big glut of supply in oil, we do see a price move downward. But what you're saying is it's stickier for copper and other critical minerals?
Well, sorry, but the answer is going to be a bit complicated. And I don't know how far you want to go in there. But for one thing,
sure.
When you drill for oil, if you hit it, or gas, if you hit it, that exploration well is your mine. It is your production well, right? You cap it, you put the stuff on it, you connect it to the network and so on, and then you're busy, right? If you make a discovery, like if they announce tomorrow, we hear all these crazy announcements and people get carried away. Oh, China discovers, $100 billion gold deposit. Like, even if that was true, usually it's not, by the way. It's just some guy's estimate of what it might be worth with no economics, no metallurgy, no hydrology, no engineering studies, none of the things at all that define the economics of a project. It's just some back of the envelope number by some promoter. But even if it was true, it would take years to build that mine. So supply is pretty price insensitive. Like, it takes years for high prices to cure high prices and low prices to cure low prices. Well, okay, high prices cure high prices on a higher frequency basis. But even then, if you've got a mine and it's not done, you're not just going to shut it off. You're very reluctant to put it on care and maintenance because that's expensive by itself. And you can kill the mine if you don't adequately put it on care and maintenance. So if you think prices are going to come back, you might continue mining even at a loss, because you're going to take a loss on care and maintenance anyway, and B, if you shut it down improperly, you can lose the entire mine when it might have future value. So, high prices don't actually always cure high prices right away in the mining space. It's a slower moving thing. Now, and sorry, I won't go too far, but one more complication on the little oddball metals, that's much more volatile. You can have a sudden new entrant. If you've got some tiny thing, gallium is really important, but it's not used in hundreds of thousands of tons. It's used in, micrograms in your phone or something, right? So if some private Chinese company, had a significant new mine and it was private, so we don't know it's coming, they could suddenly hit the market with new supply, assuming the Chinese allowed it to be exported, that we wouldn't know about. So the smaller oddball metals are harder to predict. They're more volatile. But the bigger ones, we can generally see what's coming.
And also the fact that most of the refined copper comes from China. Okay, let's move on to gold. We haven't talked too much about gold so far. We've talked about silver. Does silver and gold, do these metals have a similar story? In other words, if you're still somewhat positive on silver, I'm assuming you're still somewhat positive on gold, or are they completely different narratives as of 2025?
No, I just made an argument for silver having got ahead based on idiosyncratic issues, including supply, physical supply in the LME and in the COMEX and that sort of thing. And the reason for that argument was to say that, don't think that they're diverging permanently. Like, this is, I think, temporary. It gets resolved, and then both metals revert to trend. My base case, and by the way, this fits into why, even though I am bullish on both silver and gold, why neither is my top pick for 2026, is that it's entirely possible that we could see more consolidation at these levels before the next big move, which I do expect to be upwards. I mean, in 2020, we had to wait 3 years before the next big move upward happened. And I'm not saying that it has to be the same now, but I am saying that if it took 3 years last time, there's no reason, to assume that it has to, the next move upward needs to be right away. It could take 3 years, 2 years, even if it takes a year and a half, we still have months to go. So I'm not bearish on silver or gold. The question is about gold. But I do think that there is a significant chance that both correct and consolidate for a while, possibly even all of 2026. And that's why, and whereas I'm highly confident that even with the short-term correction, copper goes higher in 26. And that's why copper is my top pick. To the answer for gold, central banks are still buying. The debasement trade is there. When people ask me, oh, gold's so high, how high do you think it can go? My answer is always, well, when do you think governments stop printing money? Or how low can the dollar go? I don't think there's a limit to those latter, and therefore I don't think there's a limit to how high the monetary metals can go. The difference between me and the Uber bulls who are just like buy today, right now. That's not me, because I'm willing to admit that it may be a while before I'm right about where it goes.
This is from the World Gold Council. They cited a few factors for why gold performed so well in 2025. Geopolitical risks, dollar weakness, and investment flows drove gold higher. Let's just talk about these macro factors. Which of these will remain relevant into 2026 and beyond?
All of them will be. I mean, there's optimism about peace in Ukraine. But we still don't have any word from Moscow that they're actually even interested in the peace deals the Americans and the Europeans and the Ukrainians are hammering out between themselves without Russian participation. So we'll see. But the most interesting of the three that you pointed out there is actually, I think, the investment scenario. One of the things that I know you've talked to our friend Rick Rule about is that the long-term average global portfolio allocation to gold has been 2% for decades. And recently it's only been around 0.5%. And Rick would say that if all it has to do is revert to mean, David, and that would 4x or produce 4 times the investment demand for gold. I think that's happening already. And I think that thing you just pointed out is evidence of exactly that. Now, I don't know that it goes back to 2%, but even if it just goes to 1%, that's twice the allocation of the past. That's a huge input factor. And I think we're seeing it. It's anecdotal. I can't prove this, but I listen to the talking heads on financial media, not you and I, of course, those other talking heads, mainstream financial media, which you will be soon, I'm sure, David. But anyway, you hear these guys, and instead of, treating gold like a 4-letter word, which it is, but, before, like, people would, if they mentioned gold at all, it was to laugh and sneer at the pet rock. Now, you see the money manager saying, oh, we're doing this with NVIDIA and that with Exxon or whatever. Oh, and we're hedging our bets with some gold too. Like that's coming up frequently in the conversations. And more recently, even the interviewers have come around to where the interviewers are saying, okay, well, that's really interesting. What about gold? You got some of that in there? Oh, yeah, we've got some gold too. So I think this is happening. I think this is something that's been absent for decades. I think it's material. We're talking about not just institutional investors, but, family offices and highly liquid, deep-pocketed investors that are getting the memo. And if you think about it, okay, in 2011, gold has this big spike after having been down for decades. It's easy to see why people would dismiss that. Recency bias would say, well, gee, that's a spike, it's a fluke. But now it's been 2.5 decades of rising gold. And if you pull back and look at the big picture since 1971, it's pretty easy to understand the thesis that gold offers. It's volatile. It goes up and down on every year. It can go one way or the other. But if you look at the big picture, it has held wealth. It has held value for the entire time that's been free to trade against the dollar, which has lost value. That chart, this is my favorite chart. You've seen it before, Dave. It's a giant X from 1971 to now. If you look at the exchange rate between gold and the dollar, and you look at the dollar's purchasing power, even using the BLS's CPI as input, it's a giant X. And that has lasted decades. And I think people are starting to understand that now. And that is something that's completely, I think that's this big
odd rate. Sounds a bit odd.
Paradigm shift as the central
bank. Most people I mean, everyone I know has like some gold, right?
I don't think a lot of people have this in perspective. The fact that gold has performed almost pretty much everything else.
And most people weren't expecting it to be like a strong performer, but it's just a way to have like diversification. It seems a bit, I mean, I don't know the data, so I can't say one way or the other, but that does seem like a bit odd, right? I mean, I guess we could look it up.
25 year-to-date returns.
Suppose
for
we
gold
could
asset
look it
classes
up.
in USD, DM stocks, ex-US, US stocks for the most part, commodities, balanced portfolio, US bonds, global treasuries, ex-US, US cash. I'm not talking about specific stocks that have gone up 300%. I'm not talking about silver that has outperformed. We've already talked about that. I'm not talking about some certain crypto meme stocks that have outperformed. I'm talking about these broad basket, large asset classes underperforming gold. First of all, what does that signal to you when it comes to investors' priorities for this year? And second, does that worry you a little bit as a commodities trader, investor?
Yes and yes. So an interesting thing is that you're putting gold on here versus other investments. And in a way that should, well, a couple of things. One is if you put silver, platinum, or palladium on there, they'd be even bigger than gold. But this isn't your chart, I understand. But I think it's actually comparing apples to oranges here. Gold is not an investment. It is, I think, money. It should be compared to the dollar, not to other investment classes. So if you want to compare a gold-based investment to these other investment classes, you should put the gold stocks on there, put GDX on there. And that's up over 100%. It's like 140% or something last I saw. So it's even better. If you compare gold investments or speculations versus these other investment classes, I think you see an even bigger outperformance. But to the question of what is this signaling, this ties into the earlier conversation that we put the cart before the horse here in my concerns for 2026. As you may remember from our previous conversations about the Big Mac Index and other things, gold does not correlate well with inflation. You know this. I've heard you talk to other guests about this. The correlation is actually not negative, but it's basically negligible.
Yes.
And the reason for that we've discussed before is that gold tends to lead. Right? Gold went way up in 2020, and it wasn't until a couple years later that inflation went up to 9%, at least as officially admitted by the United States government. So what does that imply about what gold is doing now? I think that's pretty scary. And I'm not going to write a science fiction story for the audience in some apocalyptic scenario. But if past is prologue, right? History doesn't necessarily repeat, but if it rhymes at all, gold going to where it has gone and silver confirming it and the other so-called precious metals tagging along, I mean, that's pretty scary. We just talked about deep pockets hedging with a bit of gold. What are they hedging? What, not just, when we say, what is gold telling us? We're really saying, what are the buyers worried about? I think that's significant. I think people should pay attention to that. Sorry, real quick. I just said I'm allergic to buying all-time highs, but I'll tell you, if I had no gold, and I just said gold's not an investment. I view gold as money. I view it as savings. I have physical bullion. I won't tell you which palm tree it's buried under, but under my direct control, that is my rainy day fund. And I have lived this in the past. I have used bullion to save my family in times of trouble. So I take this very seriously. If I didn't have that,
that's dramatic as hell.
If I didn't have that, you know what? I would be willing to buy gold today, even at these prices. If I had zero physical gold, if I didn't have gold or silver I could hold in my hand, I'd go on the Costco website today and buy some.
And hold it long term.
That's my answer to, what is gold telling us? It's telling us, I don't know what it's telling us, but it's not good, and I want insurance. And that's the first line of insurance I'd buy.
That is a perfect segue into my next question as to what exactly are you insuring yourself against? This is from JP Morgan. This is not, I don't have to remind the audience and yourself, this is not an insignificant institution publishing an insignificant post. This is their forecast officially $5,000 by the fourth quarter of 2026 with $6,000 an ounce possibility longer term. Now, there was a time when I was working at my last job when you and I first met when we were talking about $5,000 gold as a hypothetical doom scenario. It is now no longer that hypothetical doom scenario. We're not at 5,000. I'm not saying it's going to happen tomorrow, but here we have a major bank saying it's not going to happen by the end of the decade. It's going to happen by the end of next year. And I'm not going to read the entire article, but spoiler alert, not much has to change. Central banks have to continue buying, and the Trump administration has to continue putting pressure on the Federal Reserve. The Federal Reserve losing independence is one of their criteria. But let's just take this at face value.
And it was never independent, was it? Let's be honest.
What has fundamentally changed in the world such that we're talking about this at the end of 2025 and it's just status quo versus 5 years ago, this was a hypothetical scenario that was like the end of the world needs to happen for this to happen?
Well, let's come back to what's changed. Let's go to the first bit, because I think that's really interesting. I've had people say, well, gee, Lobo, you said if gold went to 5,000 or 10,000, and those were commonly numbers that were thrown out, 5,000 or 10,000, we'd be looking at a Mad Max scenario, or the world would be totally crazy.
Yes, exactly.
Okay, it's not Mad Max, but the world looks pretty crazy to me, David. I mean, we've got a hot war in Europe. I mean, that okay, it hasn't gone nuclear yet, and there's talk about peace, but no actual peace. The bombings and strafings on both sides continue. We had a hot war in the Middle East, hotter than in decades, and that seems to have simmered down. But you think Iran has given up on their goals or perspective, or I think and actually we don't actually have a peace deal in the Middle East. We have a ceasefire, and it's held. But who knows how long it'll hold. point is, there's geopolitical, not just risk or tension, but there is actual fires burning on the geopolitical front in our world right now. And then you've got the trade war, which isn't just a trade war. This is global superpowers, China and the US, finally, facing off more directly. The gloves have come off, basically. And the hegemon existent and the hegemon uprising are openly jockeying for position here. That is a scary world in which that sort of thing is happening. And then we've got the debasement trade, all these other things going on. So, it is a pretty different world from where it was when we, years ago thought that 5,000 would be a crazy number. Well, we live in pretty crazy times. And then as far as what's changed, we've touched on these already. The central bank buying, that's absolutely a game changer. It's not going away anytime soon. I think this other thing we've just talked about, where the reallocation to gold in portfolios, where it's not just gold, but I mean, that Jamie Dimon thing JP Morgan thing you just quoted. Remember Jamie Dimon a couple of weeks ago, he said, well, it's not entirely insane to own gold these days. And, it's one thing for longtime gold bugs like Gundlach who talk about, 25% is not excessive. And even though he walked that back, he did say that a 25% allocation to gold is not excessive. Well, but he's been into gold for many years. For JP Morgan, that institution that gold bugs love to hate, for the leader of that institution to come out and say, well, you know what, it's not just, crazy people who want to own gold these days. That is a huge shift. And I forget there was another one, I think it was Morgan Stanley that was recommending a 10% allocation or something like that to gold. That's huge. And to the degree that it doesn't happen overnight, but to the degree that their clients or anybody listening to them starts doing that this is enormous. So under any other circumstances, the answer to your question actually, David, is if we were in that world from before and we were looking at $5,000 or $4,000 or $5,000 gold, $60, $70 silver, I'd be very worried that we just hit a peak and the next big move would be downwards. But for these reasons, the world that we're actually in today, I think we're actually in a consolidation phase before another move higher. How much higher? I don't know. I don't do the crystal ball thing. I'm happy just to get the direction right, and it'll do wonders for my portfolio if I do.
Well, I think that was a very good recap for the year. So thank you very much for all your contributions this year. And we'll have you back on again in 2026 to see what has played out and what's changed. So Lobo, where can we follow you for now?
IndependentSpeculator.com. I have a free weekly digest that if you sign up for, we won't spam you. And let me just say one more thing. For anybody who's mad at me for not saying silver or gold or uranium is going to the moon tomorrow, remember, it's one thing to make money on a bull market. It's another thing to keep it. And if you listen, don't listen to me, you listen to Rick Rule or Doug or these people, and they talk about locking in their gains. And if you look at the broader markets, you listen to a Gundlach or a Howard Marks even, who's not a gold bug or something like that. They talk about discipline. They talk about buying low and selling high, and don't forget the sell high part. So just because I don't say your favorite commodity is going to the moon tomorrow doesn't mean I'm a bear. And if I talk about taking some money off the table, it's not that I hate all things good in the world. I'm trying to help people hang on to that money that they work so hard to make. That's my take.
Follow Lobo and hopefully learn more about his takes on gold.
True. There was one more video. It was the other ICT one. This one. It was this thing.
30 plus million, 1.1 million in payouts. I'm telling you, this stuff's easy. Someone who
Whoops.
1.1 million in payouts. I'm telling you, this stuff's easy.
Someone who has achieved over 30 million in funding across all of his traders who he has trained and actually achieved over $1 million in payouts.
You need a predetermined expectation on the day, so you'll only favor this when you're bearish. I've used this for 2 years. All my entry work has just been refinements of the alpha trading tree. I'll give you guys one refinement that I made. Money, bro. That's money. That's all you need for the market maker framework. And what you're looking for targets here is these moves, they're not going to happen every day. So you want to maximize when these trades happen. You want to make sure, okay, I want to be getting paid on these moves, right? So that's when you look to scale in and scale up. Frequency is not your best friend. A frequency to a losing trader, you're going to bleed faster. And it's way easier to capitalize on that than trade this chaos, in my opinion, man. That's a big reason why I switched from day trading to swing trading, because I realized the confirmation I'm waiting for at these levels, they're not always going to come. Sometimes you just get like a nuke. You just get a nuke and that's it. You can get same or better results trading this with less work. It's more efficient, in my opinion, to kind of just revert to this 50-minute. And most people, to be honest, they're not.
Welcome everyone back to Chart Fanatics, the go-to channel for all of your best breakdowns when it comes to trading concepts.
I need to get some food, goddamn. God, I need to get some food. Boy's hungry.
Body count high in the order book. One tap fade, didn't even look. Limit fills, get snatched like crooks. Stop hunts, cook, just read the hooks. Tap the line, no guessing. Chart so clean, it's a weapon. You buy hype, I'm testing. You chase green, I'm resting. Pull up slow, then vanish. Fibs mapped out so lavish. 618, I vanish. You get clapped, I planned it. Marcos. Late night clicks in silence. Price talk back in violence. I drew that line in science. Now you pay that math compliance.
Marcos got the thieves laid clean. Mac 618 to 786, we stack mean. Orders deep like the Villa pool. Hit that wick, now we acting cool. Splash! Stack it, 618, get the light dip. Yeah, 6, little more grip. Low 702, add weight quick. 75 hit, I'm locked in rich. 786, that's the trap door zone. Deep, biggest order, sitting on the throne. King, wick come down, feel that line. Click, Marcos flip it, trade divine. Boom. Levels on levels, no guessing it's stacked. Nah. Auto on fills, then price react. Each retrace just fuel the load. I was trying to chase, I'm already sold. Watch the math like I watch the time. Go Rolex when they touch that line. Price dip down, they screaming red. I'm getting entries, overheads fed. 618, I'm light with ease. 6, yeah, I start to tease. 702, add more disease. By 7.5, I was begging please. 786, that's beast mode. Big size, feel that candle froze. Full send hit, I'm in that seat. Marcos playing this game elite. 618, get the light dip. 6, little more grip. 702, add weight quick. 75 hit, I'm locked in rich. 786, that's the trap door zone. Biggest order, sitting on the throne. We come down, feel that line. Marcos flip it, trade divine. I don't chase them, make them come to me. Pixel perfect, this ain't luck, it's key. Calculated, cold-blooded, clean. Fibs on screen, bad bitch rolling green. Deep field hit, then reverse insane. Rip through highs, can't tame this lane. You trade vibes, I trade domain. Blueprint built, I run this game. Stack like coke in a high-rise suite. Buy so low, I resell peaks. Roomed out, star roof in the race. Marco stack size while they chase. 618, get the light dip. 6, little more grip. 702, add weight quick. 75 hit, I'm locked in rich. 786, that's the trap door zone. Biggest order, sitting on the throne. We come down, feel that line. Marcos flip it, trade divine. No emotion, just execution. Deep feels Fibonacci fusion. I'm still crying about illusion. Marcos just ran up a revolution.
Yeah, they ain't believe in the vision. Mama had tears in the kitchen, now look. Mom was crying while the rent passed due. Now she count blessings with a sky view. I was down bad, no one had a clue. Now we all good, whole crew came through. They ain't see the map, just a doubt in they face. Now I'm cruising slow in a starlit wraith. Never needed luck, I just needed some space to build it from scratch, now we floating in grace. I was in the dark with a pixel dream, trading in pain, trying to find my thing. Late night chart, steady chasing green. Mama said pray, I said watch the screen. Whole fam slept while I mapped that zone. Woke them all up when I touched that throne. Golden pocket entries, built this alone. Now we eat well, got marble and chrome. She used to cry, now her smile stay bright. I took that weight, made it fly like a kite. They used to mock, now they copy the light. Marcos the name, put the game in flight. Mom was crying while the rent passed due. Now she counting blessings with a sky view. I was down bad, no one had a clue. Now we all good, whole crew came through. They ain't see the map, just a doubt in they face. Now I'm cruising slow in a starlit wraith. Never needed luck, I just needed some space to build it from scratch, now we floating in grace. Auto-tune blessings, I let it all play. Wrote this in code, made a plan every day. Mama, don't worry, we finally okay. Math did the work, now we counting LA. Hey.
No handouts, no light. Just price
Came from the void, no echo, no cheer. Only that screen and the weight of the fear. Mama was stressing, the rain coming near. Now she infer with the diamonds that smear. I was alone, now the feel look divine. Hesitate once and you missed the whole line. Math hit coded, don't beg to be kind. Every zone I drew came back in the line. Late nights, eyes on a candle. Stress high, bro, couldn't handle. Price running, panic, I plan. Fibonacci scale like a blade in hand. 618 like a signal from Mars. Set the order, now I'm counting the stars. Whisper said he won't go far. Now they all watch charts from luxury cars. Detached soul, I don't fold, I compute. Every feel, now a loop of the truth. Used to lose sleep from the weight of the roof. Now we high rise, math get the proof. Came from the void, no echo, no cheer. Only that screen and the weight of the fear. Mama was stressing, the rain coming near. Now she infer with the diamonds that smear. I was alone, now the feel look divine. Hesitate once.
Olympic. Olympic. Hello, Olympic. Mr. Olympic or Mrs.
The world. Talking of which, today we have the record holder for the most viewed episode on Words of Wisdom till this day. There are a few people trying to catch up, but they haven't managed to do it. He's the most requested guest we've ever had. We already did a part 2, but people have been asking for a part 3, and I guess this is what you can class that as. But today I'm very proud to announce that we have someone who has achieved over 30 million in funding across all of his traders who he has trained, and actually achieved over $1 million in payouts, most of all, for them, using this exact strategy we're going to break down today. And without further ado, it is the one and only Omar, aka MBB Trader.
The intro never gets old, man. The intro never gets old.
Thanks for being here, man. And I know that we've done 2 episodes so far, for you, dedicated to you, where we've talked. We've talked about the charts, we've talked about concepts, but today finally we get to really actually go into charts and specific strategies. And where should we begin?
So let's just go into it, yeah? So it's the oldest playbook in the ICT world. So it's just what we call the market maker model, but I like to use the OTE for the entry because this, we call it framework. This isn't an entry model, right? This is framework, right? So framework, and this is everything to do with entry. We can call it entry, SL, and TP. Even we can call TM for trade management because we can do like stop loss shapes. We can know when to like let it run, all those type of things. So it's these 2 things, and we're going to this component, and then we're going to that component after. Yeah, cool. So every single, I'll leave this in. So first, yeah, oh, that's not even M. Mind my handwriting, it's not the best, yeah. So this is framework. Now, the market maker model, we can slash power of 3, right? The first things you need to know is this. Where do they rest, right? Where do you expect this framework to unfold? In our second podcast, one thing that we said is previous day's highs, right? Previous day's highs and previous day's lows, and you can even say previous week high and previous week low. Now, some people take it to the extreme and they say like any previous candle because it's fractal. So some people say like previous 4 hours.
That's the other thing about today's short, right? Today's short, man, there's so much confluence at that level. Like, first of all, like, we were super extended on the VWAP, right? How often do we come out here on the weekly? But it was like the previous week's value area low, previous week's point of control. It was a monthly point of control, monthly VWAP. There's a lot going on at that level up there today, right? A lot. But I could have sit here for the next like 5 minutes giving out reasons for this short up there. And it was Monday's high, right? That's the other thing. That's what triggered me to say that, because when he mentioned the previous day high.
1 hour, previous 15-minute. But then there's something called variance in trading, yeah? So I only like to go lowest 4 hour for PD arrays. Now, previous day's highs, lows, week's highs, week lows, daily or 4 hour levels. So these are going to be the PD arrays. So like fair value gap, breaker, mitigation block, order block. Those are the main ones, right? These areas, right?
Wait, what's a mitigation block? That's a new one. A mitigation block? I swear, these ICT terms, the more we learn about them, forms after a failure swing, which occurs when the market attempts but fails to surpass a previous peak in an uptrend or previous trough in a downtrend. Apparently, it's just backtesting the low of a failed auction. According to Google Images, this is the mitigation block. Okay. Interesting terminology. We're becoming ICT traders, right? Somehow. Apparently. Interesting.
From these key levels, we have the expectation of a market maker model to form. Right?
The more that we've seen of these videos and the more that these ICT traders come on, there is not one thing that I've seen these people mention that is not from like previous trading knowledge from like 50 fucking years ago. Not a single thing. So it seems like the whole notion that this ICT guy just branded a bunch of old concepts seems to be pretty accurate thus far.
Break it up into 2 points, right? You can break it up into 2 points. Area for setup, and then you need the confirmation for the setup, right? So what does a market maker model look like? It's going to look like this, yeah? And then you're going to get some sort of reaccumulation, and then you're going to get another run, and reversal, right? Break up, optimal trade entry. This, right? This, let's say, this is your 15-minute, right? This is your 15-minute, and you see this level. This level is any of these previous day's highs, previous day's lows. So of course, this is a market maker sell model. So this can be from running the previous day's high. Now, if you're in my Telegram channel or like you follow me or anything on social media, you already know this, right? You need a predetermined expectation on the day. So you'll only favor this when you're bearish. And I'll give you an example, right? So let's say Friday, right? Fair value gap. Now, Monday usually does this, right? Monday usually we like to see a small range day. So Monday you're going to get something like this, right? You'll get maybe a sweep on this candle. Let's draw that a bit bigger. You'll get like this. Tuesday, what we're doing is this, right? What I like to do is I'm only considering days where we open closer to these one of these key levels. I'm not going in every day trying to find this, right? Because I know where this forms is only around these key levels. So if where I'm opening is not close to this, I'm going to wait for that. So that's the patience aspect, right? When this, now Tuesday, the expectation is this, right? We're going to open up. This is going to happen from Tuesday's opening price, right? So we should open up. Let's say we open. And then we trade down like this, right? We don't have to take the next candle. The next candle is going to be a continuation of this, by the way, and we'll cover that, right? Now, this, right, is this.
Yes.
Do you see my point? So this, right, if the people can see it, right? So this, all of this candle
Is that price action?
is that price action. Now, this is all you need, right? This expectation is all you need. But the only thing is this, right? You need one of these key levels to key off of, right? Now, the next follow-up question is this, right? Let me just remove this arrow. So just make a note that, like, screenshot that this day, right, when you're opening at that key level and you're bearish, the expectation from that level is we're bearish overall. So now we should open up. We should have what we call a smart money reversal. There's two sides of the market maker model, right? So let me clear this out.
I mean, it's quite vague, right? This seems quite vague so far. Like, first of all, why are you bearish here? Why is he just assuming that it's just going to go lower? Seems a bit strange. And like even before, like when he mentions like, oh, I'm buying, like, assume this part was not drawn on the chart yet. It was just these three candles and then the green one. And he was saying that he only looks for this when he's bearish. Like, what does that mean? Maybe I'll explain it more in depth after. It seems quite vague so far.
There's two sides to it, right? So you're gonna have, right? You got this side.
Yeah.
This is as well in the power 3, right? This is your accumulation.
Yeah.
Brought the unmute. Apparently, they also added like the multi-language on the YouTube videos. By the way, if anyone's ever watching this stuff and you're from like a different language, it seems like there should be some option to like translate these videos. And when I say that, I mean like my videos, not the one we're watching, but also these two. Like I'm not sure if this is the option necessarily, but something if people don't know. Apparently, YouTube has released that, and it's gone like a wide spread across the platform.
Sorry, this is your accumulation, right? This is your accumulation. This side of the curve, right? This side of the curve is called manipulation, and this is distribution. But you want to kind of trade the distribution. So this is the distribution side of the curve. You're bearish. Now, this is why it's really important, because if you don't have a bias, yeah, you don't know which way is manipulation, you don't know which way is distribution. So, for example, people get caught out all the time. They'll start thinking this is the actual move. Like, if you're not aware that it should be a bearish day, we should expect a bearish expansion from here, right? That is when people get caught out, because they get long. You know the trend is your friend till it's not your friend, right? People get caught out here because they're going to try long through that fair value gap. If the weekly is bearish, the daily is likely to be bearish, and you're at a daily key level, chances are you're going to reverse there.
Hey guys, I hope you're enjoying this episode so far. And don't forget, we send every single strategy breakdown from every episode for free. Channel, you're ready. Trader funding. Fnatic, trade you can use and another your data F and the with a.
That's key. This is called a smart money reversal. ICT is a breaker block. Now, breaker block is literally when you have a low, a high, right? And then you run that high. So you have a high, low, a high, low, high, high, lower, low. People call this the QM. People, so retail friends are going to call it my head and shoulders, right? This is a reference point for the first entry, right? It's a first entry, and you probably won't get optimal trade entry from here to here, and we'll cover the optimal trade entry after. But this is the framework you're looking for. This is the first thing you're looking for from these key levels, right? Accumulation at the opening price, so like, you know, your Asian range. For example, we'll call this in the ICT world a classic sell day template. From Asian's range to midnight, right? To like London essentially can be. We expect like small price accumulation. There's not really like any kind of quote unquote volume, right? And then London should kind of put in the opposite end of the range. It's usually the manipulative.
I mean, there's already some flaws appearing with this, right? Like, first of all, delayed entry. If you're like, because think about it, like, what is he taking essentially? Like a sweep of some level, but like he's not accounting for like the third drive, not accounting for if it just FSPs on the first go, or like the failed auction forming, right? Like the initial pullback entry. So he's like waiting until like the deeper retracement to even consider getting in, which is like whatever, fine, fair enough. It's going to be like a higher confirmation, so like entry not as great, but confirmation percentage higher. Fair enough. But if he's only waiting for this to take them, you're probably gonna miss some trades doing that, right?
Move of the day, and then you're waiting for that breaker block. Now, you see the fingers, right? You see this. People, you see a lot of times everywhere, there's always a conversation about body close or is it wick close?
Yeah.
Bodied close. 15 minute. 15 minute. Wait, any of these levels, daily or 4 hour, use a 15 minute. So you have something called time frame variance, yeah? I have a video on this. Time frame variance is basically, you know, like how you got the investors and you got like the fund guys levels and whatnot.
Yeah.
They talk about the noise and how 1 minute chart is just all noise. The actual word for it is the variance. So if you look at your 5 minute and your 1 minute and your 3 minute, yeah? So like, let's say again, right, let me just clear this because it's important, because time frame alignment, you know the time frames you're using in trading?
Yeah.
I think that's most people's problem is they have no time frame alignment. Like they're good at the daily bias, but then the entry level is just, I don't know, like they just go like really left.
Just before we quickly move on, as you mentioned on that previous diagram, the problem is a lot of people get long. They think the trend is your friend. What this is really doing for you and the people at home who are listening to this is it's allowing you to really identify, here's the overall move that I should be looking at.
So the market maker model, yeah, from, you see that move on the 4 hour daily retracement, you can have a 15 minute market maker sell model, right, is a 4 hour retracement expansion.
Yeah.
So for example, yeah, if your 4 hour is going like this into a fair value gap, or this is your daily, the 15 minute is going to look like this. This is the fractal that is going to look like on the 15 minute.
Yeah.
Right? And then let's say this level, right? Then it's going to get there. And then it's going to happen. Yeah. This is your 4 hour. This 4 hour retracement, you see this right? This leg here, right?
Yeah.
Is manipulation.
Mhm.
That move then lower is this move here.
Yeah.
That move. So every single quote unquote high time frame retracement.
Oh, again, vague, right? Like, why is he just assuming that this is not going to be a structure change and continues higher? Seems a bit odd.
This leg here, right?
Yeah.
Is manipulation.
Mhm.
That move then lower is this move here.
Yeah.
That move. So every single quote unquote high time frame retracement is some form of market maker model. This is just how the 4 hour, if you like magnify it, is going to look like.
Yes.
Right? Now, it's
You know, I think a better way for him to describe this would to also be accounting or like discussing like what the level below is. Because like, sure, you're pulling back into this like 4 hour level, but like what would be below this in the chart? Ideally, it's not some key level, right? I think it would increase the probability of this setup playing out like this. Because if down here it's some like major level, like this could be completely invalidated. A much lower probability of working out.
is this move here.
Yeah.
That move. So every single quote unquote high time frame retracement is some form of market maker model. This is just how the 4 hour, if you like magnify it, is going to look like.
Yes.
Right? Now, it's really important because having that predetermined expectation of that 4 hour, when you're bearish on the 4 hour daily, yeah, and you see the 50-minute trading high into these levels in this form, you should kind of be like locking in. Do you see my point?
Mhm.
Because from these levels, right, you know, like it's to get short, you kind of need a retracement higher.
Yeah.
To sell, you want to you want it to like kick higher so you can sell from a key level, right? Or you can look to like at least get to a level, then start to like find your signatures and price. I only use one confirmation usually, or I'll have a second confirmation and no more than that. Because over confirmation, you're never going to get into your trade. Like I know some people, they like, okay, I need to wait for that, then I need to wait for this, and then it balances. Look, you're gonna get one trade a year, and it's not gonna cut it,
Yeah.
right? Obviously, you need your confirmations to be like very effective.
Yeah.
Right. So the confirmations I like to use is obviously just like the standard CISOD, change in state of delivery. You see when we make this breaker block, right? If we go here again, right? You see, they're two different breaks.
Mhm.
This is a clean break. This is displacement, no displacement. Displacement is like, you know, like bodied candles,
Yeah.
engulfing candles, right? So big engulfing candles.
Showing that momentum.
Momentum, volume has entered. Whatever helps you understand displacement, right? Whatever's gonna help you understand it,
Mhm.
just go with that in your head. Because some people say, oh, is it like when like
So many
y-
terms.
like a big when like a think of like a big sell order is coming into the market.
Yeah.
I see people say this is like the intention for the algorithm to reprice whatever floats your boat, right?
Yeah.
Displacement is like the measure, right? It's like it's like the grading of repricing to me. So when I see like this, right, like a shallow break,
Yeah.
I'll let a retracement go, right? That's my second. That's the only other thing I need, and then that next retracement, I'm on that.
So this would be one. If let's say you don't get that, the
If this is
displacement,
wiki,
would be two.
if this is like a wiki close,
Yeah.
if this is a wiki close, or the other thing is this, there's a fair value gap here.
Okay.
So it's now breaker block vs fair value gap.
Okay.
The ultimate unmovable object and unstoppable force, right? So when you have
Mhm.
either a wiki close, so it's the only two scenarios: wiki close, or there's an opposing 15-minute PD array.
Mhm.
Because this is your 15-minute chart. Am I gonna dip down into this, and this is a total sweep to go higher? Let a retracement go. This is what people call the silver bullet. This is the second retracement,
Okay,
right? Silver bullet. This is the second retracement, second leg of distribution. Now you see, like here, if
The silver
one of those
bullet.
is a good
The
close,
fuck is the silver bullet? The ICT Silver Bullet is a precise time-based trading strategy from Inner Circle Trader focused on specific 1 hour windows, either the London and NY AM/PM, to find high probability entries using fair value gaps and liquidity sweeps. Okay. This looks like a retrace into a single print to me, but interesting.
And this is.
I'll go brush my teeth real quick and we'll pound this thing out.
Pixel perfect when I breathe in the dark. Limit place, now the candles embark. Autumn doubts gone like a spark. Just me to charge in the art.
Marcos trades. Deep in the trenches. Big wave, big meth. Yeah. Set the wave, I surf, I move it. Whales get clipped when the math too ruthless. Trenches cold, but the wrist on stupid. Size get dumped, they pray, I prove it. I'm the current, they just floating lost. I hunt depths, they don't know the cost. Wick get tapped, that's blood in the sea. I got feels with a pressure peak B. They see splash, I see trap, I said it. Zone get drawn, well steps regret it. 618 like teeth embedded. I bite back when the sea look hectic. I'm in stealth, no sonar blip. Got size so big it'll flip, they ship. Lick map blink, that's bait to grip. I just sit then pop that clip. Trend setter, I chart the swell. Pulse of the tide, I rid that well. They just swim where I cast that spell. Every reversal, I ring that bell. Set the wave on surf, I move it. Whales get clipped when the math too ruthless. Trenches cold, but the wrist on stupid. Size get dumped, they pray, I prove it. I'm the current, they just floating lost. I hunt depths, they don't know the cost. Wick get tapped, that's blood in the sea. I got feels where the pressure peak B. Deep sea pockets, that's where I dwell. They chase pumps, I wait and shell. Flip get marked and the trap get set. They swim loud, I move in stealth. Float through charts like I breathe that tide. Bad bitch rolling while I glide. POC get kissed and slide. I front run trends, they chase and cry. No clout moves, I just set the tone. This the ocean math on a platinum phone. Whole crew fed on precision zones. We hunt whales, they die alone. Set the wave on surf, I move it. Whales get clipped when the math too ruthless. Trenches cold, but the wrist on stupid. Size get thumped, they pray, I prove it. I'm the current, they just floating lost. I hunt depths, they don't know the cost. Wick get tapped, that's blood in the sea. I got feels where the pressure peak be. It ain't luck when the ocean bends. Just pressure, math, and patience. Marcos. Marcos. Yes, sir. Didn't believe it, huh? Fresh. Migo. We know. Man made millionaires. Back then they ain't care. Now my whole fam in the air. Private flights, no stairs. Golden fibs, I swear. 6'1" Lounge truck, 2-tone glare. TP hit, I stare. Ding. Money talk loud, they scared. They laughed at the plan, I spars with the fam. Used to run stop loss, now run the land. Backwards field chart still in hand. Had no help, just math, no scam. Mom and Dior, niece got bands. Auntie and Benz, all from scams. Did it with skill, no boss, no chance. Price move once, I advance. Soon, I don't miss sniper mode. Money. Wick through high, that's overload. Move. Risk to reward, I drove the code. Now I'm ice while they the code. Man made millionaire. Blink. Back then they ain't care. Now my whole fam in the air. Private flights, no stairs. Golden fibs, I swear. 6'1" Lamb truck, 2-tone glare. TP hit, I stare. Locked in. Money talk loud, they scared. Plotted in silence, counted the ticks. Late night with charts, no clicks. They mock the math, now I'm rich. Ops got wrecked, I ain't flinch. I ain't flex, just showed the path. Kept it tight, I played the math. Now my circle living like grass. Up and to the right, no cap. Fibonacci. Out of my math. They ain't believe it, now they made to read it. Marco. We fed the fam with a math.
Marcos. They see the wins now, but they ain't see me in the red. Late night pain. No help, just math. Yeah, it's candlelight war, no sleep. No. Tears on the keys, just me and the heat. Price ran wild, I ain't retreat. Midnight lows made the house so sweet. They talk racks, I bled for this. Charles got scars, yeah, I thread that stitch. Used to be pain, now it's profit ticks. But they ain't dead when the soul got hit. Dark room 3 AM, heart sunk deep. No lights on, but a V-Walk beam. Snipe from lost turned into scheme. Now every trade got a hornet gleam. I tweet, I just flipped the zone. Marked up levels with a cracked out phone. Smoking a year blunt to the dome. Wasn't no help, I was all alone. They cheered now, but I paid that cost. Stop loss hit like a gunshot cross. Reload quick, couldn't count that loss. Math in the veins like I'm wired to the ball. Just candlelight war, no sleep. No. Tears on the keys, just
money, bro. That's money, right? That's all you need for the market maker framework. And
money
for targets, yeah, is you see this low here.
Yep.
You're trying to work towards this low.
Okay.
Right? Now you'll manage to trade as it's going, like you start to shave your stop loss off, try to get break even. If you can get break even here, try scaling again. Like your trades, right? Your biggest trades will come with scaling in. How I like to scale in is this: if I'm break even, I always have like a fixed risk on the trade, like 1%, for example. If I get fixed to break even, I got another 1% to play with. And why it's so good, yeah? Because my risk, okay, worst case is going to be 1%, right? If I get in 2 of those, the leverage towards the profit is doubled, but the risk side is only 1. But if I get that to break even again, I can look to add more risk on again. But if I get that to half, then I got half. Whatever risk I knocked off, I can look to scale that back in. But that's hard. It feels uncomfortable. It's not the easiest. People rush it. But
that's more the advanced level.
Definitely. You need to like, it's like picking up a football and trying to do skill moves straight away. You won't be able to do it, right? Over time, that's definitely the focus, because you'll make the most, because these moves, they're not going to happen every day.
Yes.
So you want to maximize when these trades happen. You want to like make sure, okay, I want to be getting paid on these moves, right? So that's when you look to scale in and scale up, right?
Do you ever notice traders making the unfortunate mistake of buying here? Right?
You can.
To sell, but the problem being that they buy and then hold that buy. So by the time they get here, they think, well, I should hold this longer.
That's a good question. Yeah. So if you're a London Open trader, some people trade the London Open, right? So there's 2 schools of thought. There's 2 schools of thought, and neither is wrong, right? You trade to the manipulation, or you trade away from the. You trade to the key level, or you trade away from the key level.
Okay.
But in my opinion, I like to trade away from the key level. I've traded 2 key levels before. Like if I see like this, right? Personally, I'm a swing trader, so if I see this 4 hour, right, and I got like a decent, I can get like a 2-to-1. I can just hit the next open, put my stop loss a little under there, and take profit in that fair value gap. You see my point?
Yeah.
But with this as well, you need like a strong conviction. But the only thing I don't like is if we don't get to that fair value gap, you're gonna like, as you're getting close to it, you know, it could just run short of it. Like you might get an S&T in the market, for example. Like let's say this is the euro.
Yeah.
Right. Euro might not get there. Pound got there. Euro has weakness.
Yeah.
So you might not. Yeah. So you're gonna get that divergence, and you're trying to long, and boom, you're just on your ass. So I personally like to trade away from the manipulation. But you see, the best day that this is offered, yeah. Mind if I rub all of this out? So take a screenshot of this, right? So remember, these are your key.
And in general, yeah, like agree in the sense that like it's always better to be trading at the key levels, right? Like if this is like one key level and this is like another, and you just like bounced off here and you're like coming up. Ideally, like you're getting into trades like here or here. At this point, you're kind of like in the middle of like the range of these 2 levels. Like yeah, you can look for like a continuation trade, but like there's a world where it just kind of reverses, right? Which is fine, right? Getting in on these trades is fine in either direction, whether you want to get in here for a short or like a continuation trade for a long on a pullback. It's like kind of the usual thing though, kind of like just look at the data and determine what's the most probable scenario of these 2. If you're going to be looking to get in the middle of the range. But usually the higher probability ones are going to be these like larger time frame key levels.
Chart, consider this one 4-hour chart, a retracement into a key level 4 hour. It should look like this on the 15-minute, and you're trading that. And the cue to know that it's happened is you get this smart money reversal, you get the breaker block with displacement. It's closing nicely under it, and then we'll cover the entries after. But that's the framework: manipulation, breaker block. The right hand side of the curve is what you're looking to trade mainly, the distribution side of the curve.
This is what you meant earlier when we asked a particular question in terms of time variance. This is it.
So this is your 15-minute, right? So this is 15. Now, on your 1 minute, it's going to look so crazy. Like you're going to get, like, you know, this is going to be a 1 minute chart, and then it's going to get there, then it's going to be like, it's going to look like this on your 1 minute chart. There's going to be, look here, there's going to be, the amount of candles here, there's going to be 15 times more there. Yeah, there's going to be 15, and you know how I see it is this, yeah? 15 times more the work. People think it's less work going on. No, it's more work, because you're reading more data. You're reading 15 times. Look, I think 15 and 30 is better than 15 and 5. I think 30 minute is like a slept on time frame.
This guy bucks with the 30-minute, right? Okay. It is alright. 30 minutes is like a pretty, like, well, first of all, it's like the TPO is based on the 30 minutes, so that goes like hand in hand. But in general, it's like a pretty good time frame, right? You get enough to get action on a pretty regular basis, but also catch the larger moves while not getting baited with the smaller stuff. Like when you wait for a candle close in the 30 minutes, you're usually not going to get got too many times.
Every single, you see all of these?
Yep.
You're going to have all of these stop runs. It's going to be so erratic, you're going to have all of these stop runs. People say, you know, yeah, oh, he just doesn't have the skill. Look, I've got videos of me trading the 1 minute back in like 2022 when I was day trading scalping. I'm telling you, yeah, you can get same or better results trading this with less work. It's more efficient, in my opinion, to kind of just revert to this 50-minute. And most people, to be honest, yeah, they're not. It's not like a dig at people. You might not be talented enough or geared to these really low time frames.
Yeah.
Like, you know, I think you need like a level of like probably like ADHD or like a really insane focus, yeah, to like really like.
Your
it's
mind
easy
needs
to get
to really be able to move quickly, and you need to be able to handle because with this side you are, regardless of how fast you think and how fast your mind is going, you're still going to face a lot more when it comes to the break evens, the losses, etc. So taking Kane as an example, you know, when he mentioned his was the 3 minute, it wasn't even the 1 minute, but he says that the reason that a lot of people try and do this and they fail isn't because of the model, it's because they don't aggressively manage and handle so many break evens and be okay with that.
As well, you know, like what I'm saying, this a good analogy I can use is that, you know, some people just, if I chuck numbers at you and I tell you I just keep adding them like 10, 15, 8, 9, 1, 1, some guys can just tell you, yeah, what the sum is, some people can't. It's like some people can read the 1 minute, but the thing is that they're trading the 1 minute, but they're also considering the 15 and the 4. Right? When you're trading the 1 minute, you have more things to consider and at a faster rate. So in my opinion, it's a safer, more one size fits all if you just consider daily 4 hour. I promise you, look, I know so many people that used to be the 1 minute and they all revert back. Like usually how the thing goes, they start here, they think, all right, cool, I can just get more trades because it's fractal. I can get more trades if I go down a time frame.
Yeah.
And what happens is they see like this is actually not what I thought it was.
Yeah.
And then
it's
they
the
revert.
allure, you know, high risk to reward and you know, more precision, etc. versus the chaos that comes with it. Because I think one thing I know, I took 2 years break from trading and I just started this year again. And the one thing I don't miss is that regardless of, you know, your financial situation, you having an edge, you will always, to some degree, feel when you're in drawdown, feel when you've taken a loss, feel when, especially when it's like you start getting sucked into these lower time frames, the chaos that comes with it.
It's like, you know what it is? Frequency is not your best friend. A frequency to a losing trader is just you're gonna bleed faster.
Yeah.
Frequency is like, there's no point of going for more frequency if you're not a winning trader. And the thing is,
interesting point actually, right? Interesting point to make for people that are beginning. Because yesterday the other guy made a pretty similar point, right? That the options trader guy.
Trying to increase your frequency.
Interesting way to phrase it.
Just look at more markets.
Yeah.
Right. So you just need to look at more markets instead of trying to lower the time frames. Because you know what it is like? It's a whole different plan.
Yeah.
But
it is,
you know, like this, you're thinking, okay, that's a whole different trade. But it's like you're good at playing center on the pitch. Now you're going to try to play on the wing. You're not a winger, bro. You're a midfielder.
Yeah.
You're trying to play this position, right? Just go and do this.
And the one thing I think is very important is that even to do this, even if you want to do this, because there will be very few people out there who probably are centered towards this, no problem. But to do this, you still need to master that first. And I think that's a big mistake people make, right?
So the 1 minute guys, what they like to do is they like to use, instead of this, they like to use the 1 hour. But still, the 1 hour, you still need to kind of know where the 4 hours going. You see my point? Because of the variance. If you're day trading, right? If you're day trading, you're trying to get the daily expansion. So you want to cap your variance so that you're on a lower time frame, but it's somewhat in line with the daily. Like this is gonna not look like a bullet. This is a bearish daily candle, right? This is way more fitting of a daily bearish candle than this. This is gonna have uptrend, downtrend, uptrend, downtrend, up. This is gonna have a clear 1 move higher and 1 move lower from the open, and it's way easier to capitalize on that than trade this chaos, in my opinion, man.
100%.
Let's take a break for a minute there, guys, because I want to tell you about the best CFD prop firm in the entire industry. Funded.
Oh, the thing is, it's hard to say. Like, the thing about that statement is, regardless of if you're on like the 4 hour or the 1 hour or the 15 minute or the 2 minute or the 1 minute or like the fucking tick chart, you want to be looking at it when you're at the key level. Like if you're just on the 1 minute trading some like random sequence of price action in the middle of like basically not at a key level, just randomly traversing from one place to the next, then you're trying to get a trade in there, then like, yeah, that's like not going to be a high probability area for most people. There are some people that just have some extremely systematic model where it's like, okay, this sequence of price action starts to print, with these indicators doing X, Y, Z, therefore I'm entering the trade, and it doesn't matter what price is, I'm like, yeah, so be it. But most people aren't doing that, right? Like they'll just be looking at this in the 1 minute and be like, oh, it broke the low, therefore like smash a short. Like in this case, like sure, it worked out on the 5, but not particularly repeatable. Low EV.
Next, funded
Also, where is the button?
Chart Fanatics, and they have been leading the amount of FCC compensation. Best sure you.
Yeah. Yes, we were talking about you know, London, 2 options, right? London or
Yeah, so
thereafter.
again, you want to be opening close to a PD array, right? You want to be opening close to a PD array because then you kind of know London should trade into that PD array. It's always like this, yeah. And I always, you see, like so I always say have a trade plan for the day. So you need a play of the day. You need to kind of be already favoring a kind of play, like a playbook for the day, right?
Yeah.
So for example, I know if we're overall bearish on the week, yeah. If I'm bearish on the week and Monday. If Monday trades higher, Tuesday, right?
How does he determine this? I don't get how, like, what kind of like system is he using to determine, oh, I'm bearish on the week or not? Because I don't believe that stuff. Like being bullish, bearish, I don't really believe it, right? It's like the chart is printing at key levels and it will tell you if it's going to be bullish or not, right? So you're just reacting to what's happening. You're not sitting here expecting something. At least like not with like a determined set mindset. Like, yeah, this is definitely going to be bearish. Because you don't know, right? Until you see the reaction, you don't know. Like, sure, there could be some like massive liquidity cluster that's about to get swept on a move to the downside. But you don't know if it's going to get this and start going again, or if it's going to get it and just start blowing lower. So curious as to how he makes that determination.
This one and reversal.
Hopefully he explains it when he does these actual chart examples.
I'm favoring that straight away.
Out of curiosity.
Previous day's high, you're gonna get that. Previous day's high, and you're gonna get that breaker block, and then you're just trying to trade that way. Now, if you're a London Open trader, right, you might get that even in London, and you'll try to position that. If you're in there in London, hold the trade through the day, because the data shows, yeah, the low of the day is gonna come after like 3 p.m. New York time. So you hold it through the sessions, right? So you got your London Open, which is 7 to 10 a.m., and then you got your New York Open, which is 12 to 3, and then you got London Close, which is another slept on kill zone. It's like the ugly child of like the kill zones. It's London Open is 2 to 5. I said it in UK time. In New York time, it's 2 to 5, and then 7 to 10 is New York, and then 10 to 12 is London Close. But you know when London Close is good, yeah? When you have those 10 a.m. folders, you know, on Forex Factory, right?
Yeah.
And they're usually on like Thursdays or Wednesdays, right? I believe consumer confidence is always at 3 p.m. That's the UK time. 10 a.m. New York time. That's when the London Close is good. So depending now, right, on that level of market maker model and AMD, right? Then the rest is profiling the day. So profiling the day, for the people that don't know what profiling means, is how is the day going to build that candle. So this can be London, right? This all can be London, and then you'll get here. And then New York is what I like to call the London to New York optimal trade entry. So you got this high from London, optimal trade entry, right? Now, before this is London, and you might get this in New York, right? New York, and then like 8 a.m. New York time, you might get that in New York, that breaker block, right? And if there's still time in New York, or it's a London close kind of day, like if basically London close is good when New York, you know, if this, if this is like 9 a.m. New York time, one thing that ICT traders don't really consider too much is ADR. It's a retail concept, phenomenal, right? The ADR, so for example, if you look at the size of the daily candle.
ADR is average daily range, right?
Yeah, so traditionally people use a 5 ADR. Some people use a 3 ADR, some people use like 7. I use 5. It's kind of like, you can just eyeball it as well. You don't need to really consider it. So, you know, what people don't realize is, you know, like, let's say this is...
I mean, you're better off using the number than eyeballing it, right? You do have a quantifiable output. You don't have to just guess.
Say that here, right? Let's say it here. You open and you sweep that candle, and your candle's only this big. In New York, your candle's only this big. By the end of this candle's lifetime, you know that this candle should be down here.
Yeah.
But so you got this space to capitalize on. People don't realize that, right? So that's New York, and the candle's looking premature.
Yeah.
London close can offer that second leg,
yeah.
right? Now, the only time where people say, should I get this third leg? If there's no ADR here left, you'll see like something like this happen. but then you'll just go sideways
It's
on the
holding
day.
for the rest of the
And
day.
you don't want to be there, and you just have to accept that I was late and I should have. It was an execution problem. I don't know why I didn't get in here, and you don't get that third leg really, right? Now, remember, so everything now we've kind of covered is this, right? The market maker framework. Remember, now we can cover like the optimal trading tree,
Yes.
right? So that's the framework. So remember, you need a predetermined daily bias, right? You need your key levels, 4-hour minimum, in my opinion. It's just better quality, like you get better quality from the 15. You can use the 15 and the 5 together, right? But the way I like to do it is this: the 15 has to do the reversal, have the change of the state of delivery, and then the 5-minute can be used for like, I'll give you an example, yeah. Is this a black Yeah, cool. So you know, like this, yeah. You might get something like this. Let me just quickly draw it. You might get something like this, yeah. So you got this. This is the same thing, yeah.
Yeah.
You get what I'm saying? So
Yep.
this is your. Let me draw that like this, and then you get this, yeah. This is your 15-minute, right? You know the 15-minute candle. Obviously, there's going to be 3 5-minute candles. The 5-minute is going to print at a faster rate, right? So when the 15 has kicked that in, right? The 15 has done that. You can then look to the 5, and the 5 from here might have left the fair value gap. So you see, like these candles on the 5.
Yeah.
On the 5, it might have left the fair value gap already. And then you see this candle. You'll see this candle might open, and it might wick and then trade down lower. That 15-minute wick though,
The break.
is a 5-minute retracement quickly into this fair value gap, and then continuing down lower. That's this 5-minute up candle is that wick.
Yes.
Do you see my point? So before that fair value gap gets lifted of the 15-minute, it will show itself, right? A 15-minute big displacement candle is like your 5-minute fair value gap. So if you see a big displacement candle in this region that breaks it and leaves that breaker, that's when you can elect to use the 5, right? You can use the 5 there and see if there's a fair value gap. And that's it. That's the only time I'll use the 5. Other than that, it's all 15-minute. Because you see, once you get stuck on the 5-minute, as this prints, it's going to leave more fair value gaps. And if you get short-sided only on the 5-minute, a lot of times what people do is look at your losses here on the 1-minute and 5-minute. If you're just trading the 1 and 5, look at your losses and then look on the 15-minute. Your stop loss is probably bang on some sort of 15-minute fair value gap. But again, you got short-sided because you're just too zoned into those very low time frames. You see my point? So on the 15-minute, you know, it's safer, it's better, it's a bit slower, right? Speed is not always your friend. Too much velocity, like, you know, what just happened on the S&P, like a minus 10% week. That's sickening, like velocity. You don't really want all of that volatility. It's not too much, like it's that scalping gold. It's gonna make you sick, in my opinion. So now going on to the OTE. So what we've already established, yeah, is one side of the curve, right, and then this side, right. So A, M, D. Accumulation, manipulation, distribution.
Yes.
And this is what we want to trade, right? Distribution is what we want to trade, right? So the next question is, how do I align with the framework? It's simple. Optimal trade entry, right? It's if we draw a fib, right? You got a fib.
Yep.
I'm gonna eyeball this and say this is the 50. Yeah. So this is your 1 level. This is 1. This is 0. This is 0.5, and you have 3 optimal trade entry levels, right? Like this. Golden Fibonacci retracement, same thing. It's literally like there's no difference.
Yeah.
There's no difference. You can call it golden fib, right? So
61.8, 78.6.
we call it 62.
Oh, really?
So what's the difference? What's the difference?
0.2.
This is 0.705,
Okay.
and this is 0.79, right? Now,
I mean, there's a difference, right? There's definitely a difference. Him doing this, like, it's not gonna. Okay, this won't always be the case, right? This is like not some super common thing, but it does happen a lot. Like today, for example, literally today's like a perfect example of this, actually. Like this thing, like a lot of times it'll wick right to 618 or even a little earlier because people are trying to like front run the initial orders. So like if you're using like the 6.2 like he is, there's a world where you're not going to get filled, right? So like, yeah, there is a difference. There is definitely a difference. Especially because like for any algorithm that is using those levels to execute whatever it may be, they're using the exact levels.
right? This is your entry. So you'll have some sort of swing made, right? You'll have some sort of swing made, right? In the market.
And the same applies for the 786. Not sure where they got the 705 from. I feel like the 702 is like the middle of these, right? The 50% level of this and this. I'm not sure how they got 705 from that. It's up to you how you use it, right? At the end of the day, like you can kind of. The thing about this is it gives you a gradient essentially to use. You can like average out whatever orders you have here in some like gradient manner. But yeah, like the key levels that come on like the default fib, yeah, I wouldn't go changing those like that because that's a lot of people are using. Like these numbers, like 618, 786, 6382. I wouldn't put them like change it to numbers that are higher than that. If anything, you want it like a little bit lower. But shout out to the math, right? This guy's using the fib too. Fuck with that.
In my opinion, yeah, this is where filtering becomes very important. Now, you see when you're on your 4-hour chart, not every retracement in your thingy comes to the 50%. Yeah, not everything comes to the 50%. When you come to the 4-hour and the daily, I say take every single key level as it comes, even if it's not in the 50%, just because you're going to be looking for confirmation there anyway. On entry level, confirmation's done. Confirmation's done. You're just looking to hit it. So now, because confirmations, there's no extra confirmation. Because now, if you want to wait for, I'm going to wait for a break in the fair value gap, bro, you're going to miss the trade.
Yes.
You see, like, just hit the level. And we'll cover that as well. That's a big reason why I switched from day trading to swing trading, because I realized, like, the confirmation I'm waiting for these levels, they're not always going to come. Yes. Sometimes you just get like a nuke.
Agree. Like, we've talked about this a lot, right? Like the idea of how do we phrase this? Like it's gonna sound counterintuitive at first. But like a lot of times waiting for confirmation is the reason you don't get a chance to get break even on your trade. Because like let's just say price is like coming back into some zone. And like you're getting filled with your orders here as it's coming into the zone. Because like based on what you're seeing in the data, it seems like a bounce here is quite probable. So like you're getting filled as the price is coming into your orders, and the same with everybody else that's doing this. So like that, then you get the initial bounce, and then you can break even already. Whereas like let's say price is like doing this and had like a little bump there, and then someone gets in on like this structure confirmation up here, or like waits for that pullback. It's too late. At that point, the probability of you being able to get like, first of all, if it does go from there, your risk reward is way worse. And secondly, like if this zone bounces initially and then it doesn't hold and starts to pull back, you're probably going to be losing this zone. So like getting in on the first bounce immediately, like anticipating it, there's like a huge difference, huge difference. Yeah, definitely agree with him a lot on that, right?
I just hit those levels on the 4-hour daily. I don't need to wait for a lower time frame model. So I just kind of skipped that because my direction was pretty good. That's why I changed it. But back to this here, you need to get good at filtering here. Anything when you're shorting, right? When you're selling, anything under, in my opinion, the 50%, nope. 50% or nothing, right? Because that will give you at least a 1-to-1. Stop loss for now, right? Yep. Stop loss for now is always going to be here. So red, SL. Green.
Also, this isn't true, right? Like the 382 is pretty important. For him to like leave that out is a bit odd. Like, we've talked about this a lot. Like typically after like aggressive moves in one direction, you're not going to get more than a 382 pullback in the other direction.
TP, right? you always want to get a level of premium. This is when, you know when people say you always want to sell in a premium, we mean entry level, not daily 4 hour. You want to be selling at bearish key levels, but not every bearish key level is inside that premium. Do you know, like there's going to be a fair value gap at the 50, maybe a bit under, especially, you know, that breaker block. Breaker block never going to be here. Breaker block is low in the thingy, but there's specific times where we're going to get in ahead of this optimal trading tree, right? 62 level off the top of my head, and this is why I love it, yeah, is always going to give you that 1.63 R. This is like I think it's like 2.35. It's going to give you 2.38 R. And this is going to give you like 3.7, right? If you enter, because do you know what it is, yeah? You know that some people, they rely on like a fair value gap, or like they rely on a specific PD array, but it can be at different levels in the range. Objective. All this is measuring is, so from this high to this low, 60% of the range. That's all it's measuring, just 60% of the range. I'm just trying to sell, like, I want to sell, but I want a 60% this premium. I want to sell at a nice premium. So sell at every single time you sell at this level, with your stop loss at the 1, TP at the 0, you will get that R. No matter what, you'll get that R, right? 2.38, 705, objective. These won't change, no matter if the range is, no matter if the range is this big or that big, because it's a percentage of the range. It's fixed. It's fixed. That's why I love it, because now, you know, when your take profit is fixed, yeah. In my opinion, this is when consistency starts to creep in, because now your risk to rewards are going to be the same, right? Your risk to rewards are going to be the same. I've used this for 2 years. All my entry work has just been refinements of the auto trade entry. I'll give you guys one refinement that I made. The chances of SL at the 1 happening, and if you had the 0.9 level too, you know that area between 0.9, so 90% and the 1, right? The chances of your trade hitting 90% and keeping the 1 in between is less than 10%. It's like 1 in 15 trades. So it's very low. It's like 5% less, it's 5 or less percent. So if your stop loss now, if you know now, and this is the refinement I did over time, like, okay, if I'm getting stopped out, is the 90% also stopping me out? Because then it's just the easier invalidation level. Do you see my point? You want to put it at the level of invalidation. So instead, yeah, maybe this is the 90%, and you can put your stop loss there. You know what the risk rules come with this now? Bro, this is 2.2 R, 3 R. I don't even know, because 79, I don't really use 79 too much. I'm usually within here. Probably 5 R. 50% comes 1.2 R. And now, if you're in between 50% and 62, you'll get.
It's a little iffy, like. But the thing about this is that, like, a lot of times, let's just draw this, right? Let's say you're getting filled with the fib, and you have, like, let's say you just use, like, these 4 levels, and you scale in with, like, some kind of like pyramid type structure on these orders, so they get bigger and bigger as it comes down. And price comes here, and this also depends on the time frame. Like, the lower the time frame, like, the less applicable this is, but like the larger the time frame, the more applicable this becomes. The price comes and then it bounces, or it doesn't bounce. So your orders get filled and it just starts going through your orders. A lot of times it'll do like the 886 bounce, and then it'll do it the golden pocket retrace. And it'll like wick through this sometimes, right? But this bounce right here lets you get out of this trade, right? Because like your average entry is gonna be like down here somewhere. So like this affords you the opportunity to get out of like because most likely what's gonna happen at this point, it's gonna roll over, right? More often than not. Sometimes it'll like retrace to like the higher levels and then do like a retest of this, in which case, okay, fine, you have some breathing room. But like when it starts to do this, you have the chance to get out, right? So what would have been like most likely a losing trade here, you now get out break even. But if you're doing what he's describing right now, where you put your stop at like the 0.9, which is like right below this, you're not afforded this opportunity. So it's like subjective, up to you, but like you are kind of cutting yourself off from that potential method of risk management. Because there are also people that will put their stop here just simply for like slippage reasons. Because if you put it at the exact low and it starts like cascading down with everybody else, then you're gonna get like a lot more slippage than if you get it before reaching the low.
Entry risk reward just with that one shave, right? But now what's gonna happen is this: you'll get into the same trade and you'll take more profit. And it makes all the difference, by the way. Like 1.6R to 2.2 is a big deal. Like you don't need to, if it's like what? It's nearly like a 50% more profit on each trade. If you go on a compound calculator and you do...
It does make a difference. What he's saying is pretty valid.
50%, you'll see the difference in the charts exponentially. Over time, over like 10, 50 trades.
Things that bigger picture view is what a lot of traders miss, is that they don't think on the bigger picture, and they may hear like, oh, just a slight increase, but it's thinking in terms of consistency. When you consistently hit these larger increases over time and are able to build these refinements, because off the back of this, I know, off our podcast, these refinements are really built off data. You've collected the data over time to be able to make these changes or tweaks.
Because so exactly, yeah. Because look, I say you always need to kind of be closer to what, and this is, by the way, the initial TP. This is only initial. It's probably going to kick like lower, like here, because it's a continuation trade.
Yeah.
Like you should make a new low, right? Unless you consolidate, but you should make a new low. So like you can get like 3R. If you're using 90% of the stop loss, 62 level, and you let it run to 3R, it's a very easy 3R model. It's a genuinely very like 2.5R. Let's forget 3. Because if this is giving you 2.2R, you just need a little bit under the low to get that extra like squeeze to get the 2.5R, right? Now, how would you start shaving the stop loss off? Look, yeah, guys, you need to always eliminate risk where you can. Get to break even, right? And now, people that say, oh, I'll get to break even and then it hits my stop loss and whatnot. Okay, cool. At every single point in the trade, the invalidation zone changes, right? For the people that moan about the stop loss getting hit, journal. If you don't journal, then you can't help yourself. But in your journal, yeah, one thing you should journal is this: my break-even stop. How many times, if that got hit, would my initial TP, my initial stop loss get hit? And if you see like a lot of times my break-even stop gets hit, and then my original stop loss gets hit, it's a good shave. You're saving yourself. Now, if you see your original stop loss gets hit, and it's like categorically going to your take profit so many more times, you got a problem with shaving risk. You're probably doing it a bit too fast. But with optimal trading trades, what I like to do is this, right? Say I'm entered here at 62. I'm entered here.
Yeah.
Let me make it a bit bigger. I'm entered here, yeah? Now price starts to go down, right? At this level, why the hell would my stop loss still be here, right? If it runs back to what I think, like probably here now, I'm probably going to get stopped out at my initial TP. So what I like to add here, the 0.2 level, right? So if we got the 0.2 level and we get here, at 0.2, we should be making our way nice down to this range. Eliminate risk. Get stop loss, go break even. 0.2, and you're closing there, not wicking there, yeah? Like you're closing there, like you're closing there.
Showing that displacement.
Yeah, you're closing there, because a lot of times, yeah, you'll see that candle, there's a saying, the wicks do the damage and the bodies tell the story. You want to close there, right? Once you close there, break even, I like to call it your feet's up. Like it's either now, you got nothing to lose and all to gain on this trade. Now, your initial TP is likely to be here, yeah? If you're seeing you're closing with speed towards your take profit, remove it. Remove the take profit. If you kick that, yeah, and it's a conscious decision, by the way. A few things go into it. The way I teach it to my group is this, yeah. You see, whether or not you make that conscious decision of removing the take profit, it's a coin flip, yeah, in the sense of this. Does your account need that take profit? So, for example, yeah, let's say you're selling a phone to me and you needed £100. Like you need it, you're selling it because you need the £100, yeah? And I told you, Riz, yeah, coin flip £80 or 110. Would you take the coin flip, or you need that £100 that you need to feed yourself and your family? You're going to take that. No, bro, I don't want to do coin flip. I'm going to get the 100. That's like people in drawdown or whatnot. I say just focus getting back to break even. If you're up, let's say like a few percent. Let's say you got the money, you're just selling an old phone, like this iPhone 14, you got iPhone 16 now. Coin flip 80, 120 Riz. You know what? Let's do it. Let's have a bit of fun. Coin flip. If you can coin flip your account where you can get, like you can miss this take profit and take maybe 1R.
Yeah.
Then take the coin flip. It's always a coin flip like this. That's how I think. 1R or 3R. Okay, I'm at 2R. 2R or 4R. Can I coin flip that stop loss, that child stop loss?
It's important, as you said, like to notice where you are.
But you know what's gravy to me, yeah? What is like the best scenario to me? Remove the take profit. You kick the crap out of that. That becomes your new stop loss. Your new stop loss was your initial idea's best scenario. That take profit on that low, if you remove the stop loss and you kick the crap out of that low, that becomes your new child stop loss. It was your best idea going into the trade setup. It is now your worst case scenario.
Yeah.
And then trail as it goes. So some people, how you like to trade it. So again, a few different schools of thought. No one's really wrong. It's just preference. Some people trail off R. If you're on futures, you need to be good at trading, because that trading drawdown is like fire under your bottom. So some people do it off price action, where like price shouldn't go back here. So I'll put it, whatever R that is whatever R that is. Some people just do fixed R system. I kind of gravitate towards the fixed R system, if I'm to be honest, because you're trading for the profit. You see my point? Sometimes speed rates get traded through whatnot, but R is R. Do you see my point? Price levels can get invalidated. So now that's how you trade the optimal trade entry. Now, let me just rub this off so we can make it clear, right?
Let's take a break for a minute there, guys, because I want to tell you about our incredible sponsor, TradeZella. TradeZella is the #1 trading tool in the entire trading industry.
Well, one thing we'll say about that, ideally, it's like a bit more data driven, right? In terms of like going past a level or not, and also like what level is that fib anchored to? Like the 0 level that he's talking about. But interesting way to go about it, right? Interesting way to go about, like, kind of just putting your stop there if it just ends up running.
That is great. And that form of all of it, the post on now, right, script 20.
So remember what we said, yeah? You're gonna have this. This is gonna be
This is your distribution.
yeah, distribution side of the curve. Right hand side, yeah, is right hand side always distribution, right? It could be a market maker buy model. I've done, you know what? I've done so many thingies. After this, we'll show the inverse because I've been selling UJ, so it's been a market maker sell model. So this is your first swing point. Optimal trade entries need to have graded swing points, right? This is the thing with optimal. This is everything that optimal trade entry to me is about. It's because your stop loss is the swing. How good is the swing? If the swing you think, yeah, should remain intact, anchor your fib from there. So what I like to use is this, right? Runs on stops and from breakers, or a swing that quote unquote mitigated a PD array. So let's say like a fair value gap, right? Like for example, let's say this was a fair value gap here. Again, that's a new swing because that's invalidation now. If we trade above that, it should go higher, right? So just to say quickly, yeah, break a block, the first one, and it doesn't always get optimal trade entry. You have to probably get ahead of it. This second leg, I'm only going for like 50, minimum 50, right? So if you go like from here to here,
yeah,
this is probably 50%. This is probably optimal trade entry area here, and I want to position in there, SL there, or like here, take profit there minimum.
To position in here though, are you just simply setting a
Yeah,
an order?
the hard work's done from the 4 hour 4 hour area, and that confirmation, the chain of sale delivery, is go time, bro. What other confirmation I need? Or remember what we said, if there's a rubbish close here, we'll miss that one, and we'll get this move. That is it. Because what else are you gonna wait for? Some people, you know, like some people, yeah, this is your 15-minute. You know what they'll do, bro?
Go 5
when
or 1.
price is here, let me find a 1 minute order block. Why you do that, right? You can just literally hit that on the 15, stop loss there, hit, take profit there, Bob's your uncle. Like that's it. Nothing else needs to be done.
I love it. I love it. I think let's go over just very briefly because I think people have already seen the pros and cons of this. So in terms of cons, I would say obviously it's not really a con. As we say con, but what we mean is don't watch my spelling because that's probably wrong. But what we mean is things to be aware of. So this will require patience, right? As you can tell, you know, you have your framework.
You should rename this section. Like every single episode, he has to explain this.
But once you have that, you're patient enough to wait for the trade. As Omar said very early on, there won't be a trade every single day. You need to wait for that framework. So patience, not necessarily a negative thing, but something you need to be aware of if looking to implement this, is you need to be patient in order to let that...
Just call it the nuances of the strategy or something.
Even the entry as displayed there, if there isn't displacement, being patient enough to wait for extra confirmation before looking to execute.
Grading your swing and your displacement is the key. Like on a confirmation level, the displacement is like, a lot of people, they don't wait for the candle close. They'll see like big body candle and they think it's time to get in. And then on the close, they're already entered. It's like 9% wick, and they're finished. Like they already know, like I dumped into early.
Yeah, I'm gonna put down scalping. You can scalp, but as we talked about, very erratic. You know, a lot of chaos. And there will be people out there who can do it. You know, for the vast majority, that's going to be something to be aware of and sort of stay away from.
I'd say as well, a con for that is the con for it as well is when to ditch the OTE level, like the 62. And remember what we said. So when you want to ditch the OTE level, yeah, is usually on the first leg breaker. Breaker block, the price doesn't really kind of get optimal trade entry on that first retracement. On the reversal, it will probably get 50% or less.
So you could say there's slight discretion.
Yeah, there's definitely discretion. Everything has some sort of discretion in it. Unless you're a quant trader, anyone that tells you it's a fully mechanical model is a liar. Because in the end, there's discretion on whether the trader should hit or not. Like there's intuition in trading. So that's literally one of the differentiating factors between people in any sport is always some sort of discretion and intuition. Like some people know how hard to kick a football.
Yeah.
Can you teach someone how hard to kick a football?
No.
You can't teach them like, oh, you want to get the football there. Let's say you're teaching your son how to play football for the first time. Dad, how hard do I kick the ball? I don't know how hard, just however hard you need to kick it to get. You can't teach intuition. So intuition definitely is a big thing in trading.
One of the pros though is definitely, you know, you got your rules.
And the consistency in the R.
Yeah.
Because you know people say just aim for 2R. Okay, but what about if you're really positioned low in the range? Like, you know, people that take the first like fair value gap. But if you're working off the optimal trade entry levels, it's going to give you that 1.63R.
Yeah.
that 2 point something, I think it was 2.3 or like 3.75 R, it's fixed no matter how big the range is, because you're always working in a percentage of the range. Like, you can go fact check that. If you go take your short tool or your long tool, and you just go and put your stop loss at the 1, take profit at the 0, and you filter the entry at those auto trade, you'll see no matter how you change the fib, it's the same every single time. And it's really good, you know why? Because, you know, like if you consider prop firm challenger, like 10% traditionally to pass phase 1, if you bump the risk up a bit, like to like 1.5%, right? I don't know, like for 2%, a lot of problems kick in with the prop firm. They saw you're over leveraging. Like 1 to 1.5%, yeah, at the 62 level with a 90% stop loss and a 0 TP is like 2.2 R. So you're gonna get like 1.5 times, like near enough 3 R, right? You're gonna, how many of those do you need back to back to pass? 3 filtered out back to back. So you can literally just have that as your plan, right? You say, I need 3 of these OTEs. I don't think 3 is a lot. Obviously, you can have some wins and losses, but inside of 10 trades, definitely with the auto trade entry filtered out, you can get to your profit. You can get to your profit level, because people don't have a plan. That's people's problems. Like, you know, like I tell people all the time, look here, if you get that 705, 90% stop loss shave, and you get that TP, just an original TP, 2 trades back to back with a bit 1.5% risk, and you're done. And literally, you're passing a challenge in 2 trades if you can filter that setup up and wait for that. And you can only rely on that, and you can patience. I know people that have done it. We've done that's kind of like a framework that we kind of use.
Yeah, no, 100%. That's why you can see the results.
30 plus million, 1.1 million in payouts. I'm telling you, this stuff's easy. It's, you know, the mental and like being able to like make a plan, like how to tackle a challenge, how to consider this, how to consider that, yeah.
Rather than just freestyle. And go
exactly. Some people they're just trading with nothing else in their brain other than just, I'm just looking for a fair value of the trade off. I don't know, I'm going for 2 or 3 or I don't know. You can only do that for so long to get to that next level, yeah. It's like going to the gym. If you don't track your workouts and track your diet to a certain point, you'll cap yourself. If you go to the biggest guy in your gym, tell him what you train, he'll tell you his plan so in depth. He'll know what he's eating. He'll know what he's training, how many sets. He'll know like how much he's trying to like lift, the rep range, everything. It's the difference between every single athlete. Trading is no different. The difference between a very good trader that do well is that they got plans, they got protocols for these things, and this risk for that entry here, TPs or here, whatnot.
Perfect. No, I love it. And just to finish off the pros there, we have consistency in the high time frame to lower time frame sort of rule set and your path, if you will, in line with momentum for sure. And then, you know, you risk.
Audit is cold. Goddamn.
0.2, so you can shave the risk off once you're in optimal trade entry. You've seen prices now like around 0.2, 0.3. Shave the risk off. It shouldn't go back to that level. If it does, you're probably going to be in trouble. So break even the trade. And another thing is, it's very easy. You know, like a beginner can really just look. It's levels. It's numbers on the fib. You're just waiting for numbers on a fib. You know, people that say like, you need this specific model, this, and then this break block, this new PD array, whatnot, this inverse, whatnot. Look, forget all of that. There's numbers. If you can't see the numbers and wait for that, you have a problem. Exactly. Generally, like if you can't wait for a big 62, you're not trading if you can edit the text of your fib. You can make that 62, that 705 big, and you just wait. Limit entry, if anything.
100%. Love that. Well, it's time. I'm sure everyone's been waiting for the charts, so we'll pull that out now and go over some trade examples showcasing this exact model.
Let's take a break for a minute, guys, because I want to tell you about our incredible partnership with PropFirmTrader.com. Majority of you out there are prop firm traders. You're using prop firms to leverage your trading skills to be able to get more capital and to be able to absolutely change your life. So what's important to you? To be able to find the right challenge for you with the best firms and, most of all, the best prices. And that is exactly what PropFirmTrader.com does. PropFirmTrader.com allows you to compare prop firms, be able to find the best challenge suited to your trading style, and get you the exclusive best your firm and utilize the better way for getting you will
the exact model.
Get back to the episode.
So yeah, now we have the charts out. We're going to go through and show trades that were actually taken using the exact model that Omar just went through. And where are we going to start from?
So remember, framework into the entry. People kind of mix the two things together. They think that is my entry. Like, oh, what do you trade? I trade the market maker model. No, that's framework, right? So where do you expect the framework? High time frame key levels, right? High time frame key levels. That's where we expect it. So USD/JPY overall, we've been bearish on it. There's been a macro factor for USD/JPY to kind of trade lower, and then you can see, you know, look like here, displacement. Remember, look at that body close. Look, we're running this low, running that high, right? Dim position here. But then what happens next? We've got this new range made, high to low, right?
Just to go back, as you were saying, so this is your essentially your accumulation, your manipulation, then your distribution, and then the reason you didn't position there potentially was just simply that you didn't get your OTE. So that's fine. Going back to your exact example was you then get it later on.
Yeah. So as a swing trader, right, that's optimal trade entry right here, right? But obviously I know people are more geared towards day trading. So again, these are all things that were shared in like the group whatnot. So in my Telegram channel, people that know Intermac episodes, it's all here. So you can see as a swing trader, there stop loss at the 1. The 90% was actually kind of a new thing in the last month from like the data that I've come. Okay. So I'm not gonna lie and say I used 9%. I didn't use 9% there. So from here, right, this daily PD array. Remember we said previous day's highs, previous day's lows, weekly highs, weekly lows, 4 hour plus PD array. So 4 hour plus meaning 4 hour, daily, weekly. Monthly, no need, too much variance, right? Bill scrolling, sorry, one sec.
That's okay.
Now, what you get is this, right? In Asia, with yen pairs, you kind of get them kind of moving in thingy. So we get that reversal. Now you see this move clearly. We're running this high and we're breaking down this low, right? If we go to the 30-minute, right?
One sec. Wait. Save you the headache.
I was gonna say it's gonna read.
Oh,
Yeah. If we go to the 30, right? That's a different one.
I think that 15-minute was the other one as well.
No, it was this one. It was this one, right? You got optimal trade entries, right? You got optimal trade entries from here to this low. Remember, if it meets a PD array, then you're gonna ditch it, right? And then New York 8:30. Remember what we said, 8:30. If there's ADR in the day, remember what we said, yeah. If there's ADR in the day for London, this is the daily candle. It's gonna be that small candle. Then you'll still take the retracements, right?
And what you mean by that is ADR is like your average.
You
pip
still got
range.
room to play with. You still got room to play with.
Exactly. So like at that point, if there's still room to play with in terms of the average amount of pips that the pairs move, then you'd look to obviously continue to trade.
So when you got fair value gap, like optimal trade entry with a fair value gap, yeah, you're getting 50% of the fair value gap, right? 50% of the fair value gap, just get in, right? And you can put a stop loss. Like look, for example, like here, right? You see like how I had the 90, have the 90 here, right? Bro, if price gets to the 90, you think it's not going to get to the 1. Do you see my point?
Yeah.
Now, if we delete that, and then another one, it's just until the drawn liquidity is met, and another one, and then this falls out of the kills on timing, right? We won't look to kind of enter on. You kind of see it goes kind of sideways anyway. I mean, in hindsight, yeah, this was another optimal trade entry. You would have got the initial take profit, but you see how if you can position in London, you can hold for the day. Remember what I said, because London, how a daily profile kind of works is if you can position in London manipulation, you're gonna have the whole rest of the day.
Yeah.
For that distribution side of the curve, that right hand side of the curve is gonna be like longer, so you can position there, right? If you go back to the daily, right? The next one is this previous day's high, right? So you can see, right? We have this. We're coming back down, right? We've got a fair value gap here. Now, when this is to me, what I love, yeah, is this. You got a previous day's high, yeah, and this is going to be a good example, right? Actually, let's cover this one first. So you're still here, right? You're coming down lower. Now, when you see these down candles, yeah, you're still trying to position sells in them. Now, when I got this up candle, remember, I'm bearish. So when I get this up candle and we're opening close to the high, to me, I know next day I'm going to go in market maker sell model from the previous day's high, right? So if we go 18th Feb, we go 19th of Feb, yeah. March. Oops. You know, it's usually I have a mouse. So again here, right? You can see this previous day's high. You see how we're trading up to. Remember what I said, right? That move, right? On the
Because where you started on the whiteboard, you said the first things you wrote.
It's all pretty self-explanatory at this point.
and how does that move on that? How does that candle form to take it? It will open, manipulation, takes it. This is where you're thingy. This is where you're looking to align, right? Let's go to the 30-minute again. I'm telling you, 30-minute, yeah, is slept on, man. Like, if you genuinely, it was 19th of February, yeah, right? This, what I try to do, right? Now, I'm gonna give you another OTE pro tip, right? You see here, if you're banking, yeah, the 90% is gonna be your stop loss, right? Now, you can enter 50% and put your 90% stop loss there, or if you see, right, and this is gonna show you the visual, right? If I put my fib, my new anchor, because this is invalidation level, you're just anchoring from invalidation level, right? You see how it's more optimal trade entry. The risk to reward will give you the same. So you can either just use this, right? 50% get in, stop loss of the 90%. Because that 10% that you're taking from the stop loss, you're putting that 10% now onto there. So if you're getting at 50 and the stop loss at 90, it's really like using the one swing and entering at a 60. Because you're just taking some of the percentage from the stop loss and you're putting it onto your entry. Do you see my point? So it's you can manipulate the risk to reward with that. That's why I like it. So yeah, you remember, why wouldn't we get up optimal trade entry? Because the breaker block, remember we said the breaker block, yeah, is going to get in the way of it. And then what did we say? Remember what we said? Then the second leg, you only want optimal trade entry. And there you have the optimal trade entry. Yeah, stop loss goes 90 was saved, 1, whatever. And then remember, if you're getting displacement towards your TP, there must be someone in the world that caught that whole move, innit?
Yeah, definitely.
Yeah. So this is a really good example of the whole template happening, right? Previous day's high sweep.
Because bear in mind as well, you're entering from these, if you will, lower time frame OTs and ranges that you're placing on, but then the framework came from your daily
4 hour. Yeah,
right?
exactly. And and one thing as well, right? This is Tuesday.
Mhm.
If you're nailing that Tuesday high of the week, yeah, on a weekly profile, bro, if you hold that trade throughout, you can have a monster, like a really like monstrous trade. How many of these do you even need, yeah, on like 200k capital, bro, to make like some serious returns? But yeah, that's that trade style. Why it's really good, yeah. Again, it shows you breaker block. You don't want to fetch for the 62 level. It probably won't get there. You want to just hit the breaker. Breaker is usually going to be 50% of the range. Just how the whole ranges are in general. You're going to get your fair value gaps in your breaker block, given around 50% give or take. But that second one, try and fill it yourself out. Have like the discipline, optimal trade entry, and then manage the risk. So remember, look here. Remember, I have that 0.2 level, right? When it's going to get there, consider if you got a close there, remove the take profit. You're at break even. Try go for a runner. These are extension levels you can have. Mine is 0.28, mine is 0.62. I don't really know why I have them. I just copied them from ICT from back in the day. But they seem to work. I don't know really the theory behind them. Again, UJ. You see, if you follow me, you know how vocal I've been about UJ. UJ is like all I've been kind of focusing. Now, this is going to be a good example, right? This black line again. Remember, fair value gap. Now, we opened close to the now when we're in a PD array and we open close to the previous day's high, right? So I'm bearish. This is an up candle. That's good. That's good when you want to sell because you're going to open close to the previous day's high. Now you're going to open close to the previous day's high. It's easy for price to open, trade above that high, and you can frame bearish reversal. But look, check this out. This is that high. Did entry come here? Nope, it didn't come. We missed that. So do you know what happens here? Now this is like a good gem, yeah. When you get that, go back to the daily, you're gonna see this green box. Yeah, this is a 4 hour level. When you see, yeah, you always have to kind of be monitoring as prices like printing.
Yeah.
Your new key levels are gonna form, right? So you see this, we didn't get no entry on that day. Yeah? So now the next day you're gonna continue on. We're gonna expect the candles to print lower, print lower, print lower. That's what we're gonna expect, right? So what we can do is there now we're trying to sell. There's no previous day's high to work on. Okay, cool. Previous day's high is already taken and it's expanded. Chances of a 4 hour fair value gap being left by high. So we're gonna look for the 4 hour fair value gap. Because remember, previous day's high taken and displacement, 4 hour fair value gap here, right? And we can get onto that, right? Just third, probably the fourth, yeah. Damn, it's April already, man.
Time flying this
year. Yeah, literally, man. Yep, so if we go here.
I'm flying.
30 minutes. So remember what we said? You got this low, running higher. Now remember what we said there? No wiki close. We're gonna let that go. We're gonna let it go. We wanna wait for this to be closed under. Until this is closed under, I don't care. How many legs it needs to go and close there, it needs to close there. And then you see we get this, that move there.
Isn't it funny looking back at all these trades we've been watching and they're all just the same, just a failed auction up here, right? What it is. Ding, 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 ding.
Fair value gap. Remember what we said, yeah? It's either if
same shit.
Breaking that, or there's an opposing fair value gap there. We wanna wait for that to get
even when at the top of the move on the daily, it was the same thing.
We're closing the majority of that gap. London's high to the low, optimal trade entry. That's called a London to New York optimal trade entry.
The one you mentioned.
London to New York optimal trade entry. And by the way, these aren't just hindsight. Like these are all they'll execute upon, right? And that's it. You can just take that, and then this, like I know people saying, oh, you know, like just don't know why it's doing that. Then you can see this high to this low. Way out of the session, we would have never taken that. I'm not gonna lie to you guys, right? If we go to the euro, by the way, I haven't even really done too many euros. I think this is like the one or only. So this,
click this up.
Perfect. So this, yeah, on euro. And whenever you get something on euro, you can look to the dollar. You'll just have the inverse of it.
Yeah.
So here, right, was Wednesday, and you see Wednesday we're trading down, and we're inside of this fair value gap. And I mentioned in Asia, right, we kind of took this low, and we start to really displace higher. I'll show you the times, right. If you go to this date in my Telegram channel, the 27th of March, you'll see the whole Interbank episode, like the play of the day for myself. Like we've taken the low and we're really displacing higher. The chances are we're going to probably take the previous day's high and start taking these candles highs, right? Whenever you kind of take the previous day's low and you start displacing away, the bullseye is on the other end. Someone on Twitter says he coined that. It's been around for years, right? So from there, that's your level. From this level, what do you expect to find? Your framework. and then when your framework is showing itself, then you find entry. So it's a really succinct order. Do you see my point? So you got you need a favored direction, then you need your model to form in that direction, then you need your entry inside of the model, right? You can call it the XYZ plan, and then yeah, go to your 15. This is a good example because we know we've been in so many cells, right?
Yeah.
So this is, but by the way, it's still a cell just on the dollar. So it's still a cell, but you're just buying the dollar,
yeah,
right?
that makes sense.
Selling the dollar, buying euro, sorry. So you got this high, lower, low, high, high. That's a breaker block. And I mentioned watch the breaker block. Now you see the times this is happening. Look here, this is happening in Asia. Look, this is 8 o'clock here to midnight is Asia. 8 to midnight, and this is in Ramadan. So like we're awake at this time in the UK, like to eat suhoor here. So I was mentioning, you know, we take the low and look at this energetic move here. We're probably going to run these accumulation, right? So you're coming down. Optimal trade entry. Now, the reason the breaker lined up with this as well is because the range is big. You see, as the range is getting bigger, the numbers kind of like...
Yeah, this is one of those examples where like he might not have got filled if you don't use a 618, right? Okay, like is that thing on it?
If the type...
So like that rounding error like might cause you to miss a fill, right?
range, which usually is with the breaker, like it might get to like here, then you won't get optimal trade entry with that breaker. I'll just show you what I mean. So let's say I anchored the fib there and we only made a range like to here.
Yeah.
You see like it's like barely 50%, right?
Exactly, yeah.
And then so from here 90% level matches up. Okay, you probably go 90 because from here if it runs 90 point, run there, enter, you're gonna go for at least the anchor here. Now you see this, yeah, people are gonna think, okay, the next anchor is gonna be from here to here. It's not. You always want to anchor on external ranges, not this high, right? We need to break this high and then anchor from there, right? Then you look at the low before the break on this high. And another good example, right? This day is also, there's Intermac whole episode about this. And it was actually good because in the group, the new people that joined, they're like, how did you guys got optimal trade entry? I was missed by 1 pip. And then the guys that are more seasoned saying, bro, if there's fair value gap ahead, if there's a PD rate that's ahead of it, like order block, whatnot, price won't really get there. And you take the 50% and you kind of just consider like, you know, because if you think price shouldn't get to 62, for sure price shouldn't get to 90. So put your stop loss at 90, take profit. You can either take profit at 0 or have your liquidity levels, your old daily highs. What I mean by old daily highs, if we go into that quickly, what I used for take profit when I day traded, yeah, was literally it's the easiest thing if I just hide all of this. If you're long, yeah, each of these candles highs, like the wicks when you're long, is a drawn liquidity. So you see this one taken out. Okay, tomorrow you're gonna work towards this, and then this, and then this, and if there's a fair value gap there or any PD raise, those are also draws on liquidity, right? And yeah, that's pretty much all. Actually, if you go to the dollar, you'll see this as well. It's actually pretty cool. So if we go to the monthly,
yeah,
you see what do you see? High to low, running this high, making our way lower. Now, and if you go to the daily, what have you got? You're running old monthly highs. You got market maker sell model. It's a fractal concept. Look, yeah, it's about using any time frame, right? If you get a run on a high, the time frames under that will show this market maker framework, right? Now, obviously, don't take that and say, okay, so he's basically said every run on a 15-minute high, 1 second should, yeah, okay, you'll get that, but I'm not saying it's tradable. It's going to be tough to trade that, right? So if you run an older date, if this is a previous day's high, imagine this is your 15-minute chart. Forget it says the 1 day there. If this is your 15-minute chart and this is your previous day's high, all these retracements, OTE, this one didn't get OTE, there's another one, high to low here. Volume imbalance, this is a breaker block here because this high, low, high, high. All you need is that. And then remember what I said, if you're from your daily, if you go into your chart and look at every single, when you're bearish, previous day's high sweep and then displacement lower, the next Q is that 4-hour PD rate. So you always work like, okay, there was a sweep, there's no point away for another daily PD rate because there's going to be a 4-hour one left now. 4-hour PD rate. And you're going to...
Always a 4-hour out of curiosity.
And then another 4-hour PD rate, and then a new 4-hour PD rate, new 4-hour PD rate, and until price looks like it's going to show intent for another previous day's high sweep, and then you go, it's like a sequence. Yeah. It's like a sequence, and you kind of have to wait for that, because once you kind of get one of those deliveries going there with like the previous day's high sweep and 4-hour fair value gap, you can get like a few back-to-backs. And you don't need too much. I think the prop firm stats from the CEOs that show all the stats, the best traders, less than 10 trades a month. Yeah. Less than 10 trades a month.
Less is more.
Less trade. I know guys, yeah. I know of guys, not my group by the way, because I get a lot of messages. You can imagine I get loads of like DMs. Yeah, bro. There's people that blow 2 challenges, 1 each session. London, I blew. I bought. I literally bought. Yeah, London, another eval, and I blew that in New York. Yeah. These people got more money than sense.
100%. Yeah. But I love this. I love how simple. You know, not only from the whiteboard drawings, but even translating to the chart, you actually seem more simple on the chart than anything.
Oh yeah, man. On the whiteboard is you got the practice to work on this.
It makes it easier. But no, the success has been shown through not only yourself but also so many people that I've actually interviewed as well and spoken to directly. So it's phenomenal. And I know that the audience out there, would have loved this. Drop a comment with the biggest takeaway from this episode. Any questions actually you have off the back of this, drop them in the comments below. Myself or Omar will be checking.
I'm curious to go back test that on the weekly, like the idea of I suppose is a weekly candle. And like the opening near the previous week high, like at the sweep, and then like reversal until like the like the average range for whatever candles you want. Like in the video they're talking about the ADR, we can get this for like any time frame. Be like an average weekly range. You can just compute whatever, right? The name indicator is like irrelevant. But curious to see how much that plays out, right? Also, like how to do it across different instruments. That's something interesting to think about. There's some interesting ideas to go back test from that thing. If it's like a super high probability, it's interesting. The thing I don't like about that stuff though is like at the end of the day, you usually have a pretty idea of what's going on the chart on the 30-minute, right? Regardless of what time frame we're really looking at. Because here, like, where all the imbalances are actually at in terms of like time-based, volume-based imbalances. Blah, blah, blah. And you can just see the data, right? So like you can kind of gauge a probability, like sure, does it have like can this sweep like coincide with being like the sweep of the weekly high? Sure, but you already know this. You're already anticipating a sweep here anyways. So, like, do you really fucking care if this is like the weekly or the monthly high? Not really, because you're already planning to prepare for it anyways. Like, put whatever label you want on it. But it will be interesting to collect some data just out of curiosity. All right, let's watch this guy yap, right? Market's breaking. Goddamn.
Cut 175 basis points since September. Gasoline prices are down over $1, almost 30%. Yet the 10-year yield is 50 basis points higher. The bond market vigilantes are telling you that we are still in an sticky.
Yeah, because the Fed doesn't control the long end, right? The Fed only controls the short end.
World, and that is the dominant story. It's not the labor story right now. The crypto market, I've been arguing, made a strategic mistake. All the boomers are going to buy crypto. The ones that did feel like schmucks because it's down 6% and silver's up 120 and gold's up 70%.
Jim Bianco is back. He's the president of Bianco Research. He's made a number of important calls regarding the stock market and precious metals market. So we're going to get his outlook for 2026 for bonds, stocks, precious metals, and Bitcoin. As we're speaking today on the 17th of December, stocks are down, and the unemployment rate that came out earlier this week is up to a multi-year high. So what's going on with the labor market? What is going on with stock markets overall? Jim is going to give us a breakdown. This video is sponsored by Kalshi. It is a fully regulated platform that lets you trade on real-world events, from economic data to political outcomes. Traders can put money down on their favorite teams, events, elections, and more in all 50 states, including California and Texas, and over 140 countries. Go to Kalshi.com.
This guy's still yapping?
Lin, L-I-N. Click on the link in the description down below or scan the QR code here and use a promo code Lin, and new users will get $10 when they deposit $100. More in the information down below. Jim, welcome back to the show.
Thanks, David. Looking forward to a conversation.
Yeah, 2026 outlooks we'll be giving today to the audience. We'll start with stocks and then move on to the labor market and bonds and other things. So right now we have here a down day for the S&P and NASDAQ. NASDAQ's down 1.5%. The S&P 500 is down about 1% today intraday. It's led by a sell-off in tech companies. Oracle right now, let me just show my screen right now. Big news coming out of the tech sector. Oracle stock dips 5% on the report that Blue Owl Capital is not going to finance or back their $10 billion data center in Michigan. So that deal has stalled. Blue Owl have been in talks with Oracle about funding a 1 gigawatt factory for OpenAI in Saline Township, Michigan, according to the FT. However, plans fell through due to concerns about Oracle's rising debt levels and extensive AI spending. Well, that sounds like it could be applicable to a lot of different companies. Are we seeing the end of AI funding, which is going to be the downfall of AI stocks? I mean, people knew that they were mounting on debt to finance AI companies, but I don't think you and I have talked about the possibility that their
When was this
backers are pulling out
recorded?
of deals, which is going to stop.
Because like I think it's came out this morning, right? It's recorded today, but Oracle has already responded to this, so I'm curious if they recorded this video before or after that. I suspect probably before, but
Stall some development and bring down the markets.
We might be, and I think what we're seeing is we're seeing the end or maybe the questioning of debt financed AI funding. The problem that all these AI deals have is if you look at an individual deal, you could argue this deal makes sense. But what you're not factoring into it is there's 1,000 other deals like this, and not all of these deals can all survive at the same time. And then you get some of the arguments like Sam Altman was trying to make. He's the head of OpenAI. Yes, they all can't survive, but my deal is special. It will be the survivor. Good luck to you. And now that argument is even starting to be fallen on wayside. And there's a fear of overbuilding. And the overbuilding is basically, am I going to get paid back? So what we're probably going to see is a collapse back to the concentration. Who's going to do the deals? Those who can self-fund them. Who are the ones that can self-fund them? All the multi-trillion-dollar companies that are doing this. And Oracle is not one of the multi-trillion-dollar companies right now. It's a large company, but it needs financing to do these deals. It can't self-fund them like a Meta or a Google or a Microsoft or any of those other companies.
The fact that Oracle is down nearly 50% since its top in October, is that a leading indicator for the rest of the sector, or is that just stock specific, you think?
I think for now it's stock specific because, like I said, a lot of these other deals I think can continue to at least self-fund or continue to fund. The OpenAIs, the Anthropics of the world, even though they might need financing, they'll probably get it. But for right now, what it does say to me is that we're very, very limited in who's going to be able to play in this space. If Oracle is having a trouble, and like I said, Microsoft and Google aren't, there's only a handful of players that are left that can do this.
Just today, as I mentioned, the Nasdaq is down. Nvidia is down about 3.5%. Tesla's down 4%. Well, what can we expect just for the Mag 7 going forward into 2026? What are the main drivers of valuation growth or decline, you think, into Q1?
Yeah, I think, first of all, one short-term comment for you. Today's December 17th, the day we're recording. There's an old technician from the 1940s named Art Merrill. He was one of the giants. He founded the technical analysis department at Merrill Lynch at the time. And he had a famous line that he called December 15th, the first Friday of January, the indicator blackout period. Whatever happens in this period with markets, be careful. They do things crazy in this period. And then you get to the middle of January and they undo it, or maybe they accelerate it. So if there's ever a time during the year,
kind of what we were talking about at the start of the stream, right? How it's like hard to put any weight into anything right now. Like, markets aren't particularly active this time of year, and like no one is putting on trades that works at an institution at this point. It's just not worth the risk. And also, there's a lot of like tax loss harvesting going on, right? Interestingly enough, actually, I didn't know this, but apparently, when it comes to like tax loss harvesting on Bitcoin, we'll rewind it. Okay, so like there's typically a rule, and like if you have like trader designation, it doesn't necessarily apply to you depending on what instrument you're talking about. But typically, like if you go to tax loss harvest something and sell it off, there's like a window where you cannot buy that same thing again. Like essentially, you're abusing the system, right? It's like you're selling it and then buying it back right after at the exact same price, but then you're like removing all like the tax from the sell of it. But apparently, with crypto or like Bitcoin specifically, like it doesn't apply. Because they haven't like put that into like the tax loss harvesting regulation documentation, which is interesting. I didn't know that. Very, very interesting.
Look at market reactions and go, I wonder if that's real or if that's sustainable. This is the time to basically be worried about those market reactions, is right here between the middle of December and the first Friday of January.
So it's a seasonal play, is what you're saying.
Right. I mean, it can be. I mean, it doesn't mean that everything should be ignored, but you should have a little bit more of a skeptical eye on what the markets are doing right now.
I thought the Santa Claus rally is what's driving sentiment right now into Christmas. People are expecting stocks to go up seasonally into Christmas. That's not happening?
Sort of. I mean, the Santa Claus rally is kind of a bit of a myth, kind of like, selling May and go away. That statistically, those two things have not really played out in the past as much as everybody thinks they do. But we
yeah, they're not that. I mean, like,
talk about that.
Are you telling me Santa Claus is not?
They're statistically relevant, but they're not like 80% statistically relevant, right?
field, Jim, that just ruined everything that I believed in so far. Okay.
Hopefully there's no 5-year-olds on this podcast because I don't want to have to ruin it for them.
Well, maybe they're watching. They're going to be future investors. Okay, let's move on to the labor market. The unemployment rate tipped up to 4.4%. That's, it's delayed, obviously, but it is the highest level since a few years ago, I think 2021. And this is an interesting op-ed from investing.com. Stocks are living a lie as the labor market quietly contracts. Bitcoin just told us that the game is almost over. The employment data released today confirms what the headlines have been hiding. The U.S. labor market is deteriorating at a pace not seen since the COVID crash, and yet the S&P 500 sits within 1.2% of its all-time high. This disconnect isn't a mystery, it's a mirage created by 7 companies. Well, we know this narrative, but how extensively important is this?
I think we're missing something here. You're right that the stock market, and I might add the bond market, are ignoring what you're seeing in the labor market. A year ago, 14 months ago or so, we were producing 150 to 200,000 jobs a month. The 3-month average right now on overall jobs is 22,000. That has come down a lot. Every other time that's come down a lot, the stock market was already off between 15 and 20%. It made a new high last week. Bond yields were down substantially after that's happened. Bond yields are up after 7 rate cuts going back to September of 2024, 175 basis points. They're completely ignoring this. Now, before you scream, they're living in mirage land, like the op-ed said. Let me offer you a different interpretation. The biggest driver of payroll growth is population growth. If you don't have population growth, you're not going to have payroll growth. Last week, the Department of Homeland Security put out a press release and said 2.5 million people have been deported in 2025. 2 million self-deports, 500,000 ICE arrests, and the president has claimed that there's been 0 illegal immigration into the country in the last 6 months. 0. Are those overstated numbers? Maybe, but not by a lot. If you put those numbers into the calculations, we could be looking at 0 to negative population growth for only the second time in 250 years in the United States. Why does that matter? Because I would argue that the labor break-even rate, Wall Street likes to say it's around 30,000 to 50,000. I actually think it's closer to 0. I think that any positive number is good enough. If the last 3 months has been 22,000 jobs, good enough. The labor market is not deteriorating. It is in line with population growth. That's what bonds and stocks are telling you, why yields are not crashing through the floor, why the stock market's not correcting. This is the world we live in. We have no population growth. We have no fertility, very low fertility rates for natural population growth. We have no immigration. All we need is anything above 0, and we're okay. And that's what I think the markets are telling us. And this is the hardest thing for everybody to get their head around, is that these numbers are normal. And when you have anywhere near 0 population growth, you're probably in a year going to get 5, 6, or 7 negative numbers. And you're going to get 5, 6, or 7 positive numbers. And we look at the negative payroll numbers and we freak out that this must mean we're in recession. Well, the market's not saying that, either bonds or stocks.
Or perhaps yields are still relatively high because of inflation.
Is that a fair argument to make, though? Like, okay, first of all, these people need we're talking about the birth rate right now, right? Like, that's gonna have impacts down the road on unemployment. This guy's, but like, so the argument of him referencing that data point in this day and age at this point seems like a little flawed, the logic. Right? Like, am I getting this wrong? And plus, like, the other thing about that too is, like, how does that factor in with parents, right? Because a lot of times, a lot of these adults are not working because they're on maternity leave, or just don't have a job because they're like a stay-at-home mom kind of thing. So, like, does that low birth rate now imply that these people should be seeking jobs, which means having higher employment, or like, interesting. I'd have to look at some of the data, right? I'd have to look at some of the data for this. It's interesting, like, a notion to think about.
Yes, I think that in lieu of that argument, okay, you can explain it because of population growth, that there isn't any, that inflation dominates the story. Now, the Fed thinks it's the opposite. Don't worry about inflation. It will come down. We have to worry about labor. We have to keep cutting. I think it's the inverse. Don't worry about labor. It's about population growth. But inflation, we are going to approach in February. It's hard to believe this. February will be 6 years after the initial COVID lockdowns. 6 years. And we are still at least with the last inflation numbers we have, 3% inflation. We are not near 2% like the Fed has argued. We can't even get below 3 6 years later. We'll see what the numbers from December come out. There will be, November. There will be no October number when we get that released the day after we record. But nevertheless, the inflation numbers are staying sticky high. Why is that important? Well, if the long run inflation rate is 3%, not 2, what difference does it make? The Fed uses a measure called R-star. R-star is 1% above the inflation rate. That's 4. So what that means is that the neutral funds rate is 4. We're 3.5. We're already easy. We're at accommodative point. By the way, if the neutral funds rate is 4, that puts the 2-year neutral rate at around 4.5 and the 10-year a little over 5. All those interest rates are way below those neutral rates. If we're in a 3% world, we're accommodative. The market might be worried that we're overstimulating. Let me repeat that again with a new twist. We have cut 175 basis points since September, and since September of 24. And since September of 24, gasoline prices are down over $1, almost 30%. Yet the 10-year yield is 50 basis points higher. If I just told you two things, all I know is in the next 14 months, Fed's going to cut 175 basis points and gasoline prices are going to fall 30%. Normally a bond trader would say you could skip everything else, just buy bonds. They're going to rally huge. They went up 50 basis points. Why are they not falling? I think that the bond market vigilantes are telling you that we are still in a sticky inflation world, and that is the dominant story. It's not the labor story right now.
Okay, so your argument is, let me just make sure I get this correctly. Your argument is that because there's population growth, it doesn't really matter lack of population growth. The labor market is going to remain tight regardless of whether or not the unemployment rate goes up. Is that what you're trying to say here? Just make sure I understand.
Well, yeah. I mean, basically what I'm trying to say is we produced 22,000 jobs on average over the last 3 months.
Yes. How
many jobs does the U.S. economy need to produce? Now, a year ago or 18 months ago, everybody said about 100 to 150,000, and 22 is too low. That shows labor slack. I'm saying that the number that the economy needs to produce to meet population growth is a little above 0. And 22,000 is a little above 0. And so therefore the market's in balance. Now, the unemployment rate has been creeping.
I don't know, right? Like, that doesn't apply. It doesn't apply. I don't think, like, is it just me or is that logic like incredibly flawed?
No doubt about that. But I'll point out that in September of 24, and I use that as my benchmark because that's when the Fed started cutting rates, the unemployment rate is 4.3%. The unemployment rate right now is 4.6. It's gone up 0.3 during the whole Fed rate cut. By the way, for the last 50 years, the unemployment rate has averaged 5.8. It is still a very low number. So when you look at the labor market, I don't see this.
That's fair. That's fair enough.
Fed tightening or Fed accommodation will fix. Now there is an argument that there's structural problems in the labor market because of AI and other things. You could cut rates to 0 tomorrow, and that's not going to do anything to address those issues. All rate cutting will do is stimulate inflation. That's my concern, is that they're trying to fix something with lower, cheaper money in the labor market. They can't fix. The problem isn't businesses are sitting around going, man, I'd love to hire more people, but my cost of financing is too high. If you just lowered it, I would hire more people. No, they're not hiring because either they're worried about AI or AI is replacing it, or in fact, they are hiring. But also the other thing that they might be finding is there's just not many workers left out there because the pool of people between 16 and 64, that's the working age population, 16 to 64, is not increasing because the biggest thing that caused it to increase was immigration, and we don't have any immigration right now.
Just on a quick note on immigration, so I just point this out to you.
Okay, that is a more fair point than the birth rate, right? In that case, fair enough. Fair enough argument.
A lot of the population growth, if any, like lack of population growth, but a lot of it was driven by immigration, and like you mentioned, immigration may be declining in this administration. So this is from the U.S. Office of Policy Development and Research. Renter households with worst-case housing needs are defined as those with very low incomes who do not receive government housing assistance and pay more than 1/2 of their incomes toward rent. Currently, that sits at 8.46 million households. Between 2021 and 2023. One key cause of elevated worst-case needs is immigration. Between 2021 and 2024, the foreign-born population of the U.S. increased by more than 6 million, the largest such increase over such a short period in American history. Again, that may be declining now, but that was one of the causes of a rise in worst case needs for households in the United States, according to this report by the Department of Housing. Does this require more intervention than simply cutting rates, you think, Jim?
Yeah, I think so. By the way, you're right. 6 million net in, and that number might be negative now, on that there's a net outflow. Yeah. And you're right that one of the other issues with housing is, I'll go back to 2009. Since 2009, we have had 18 million new housing units started. So for the last 16 years. Since 2009, I went there, that's the end of the financial crisis. During that same period, Bloomberg has estimated new household formation has been about 21 million. So we're about 3 million homes short for household formation. We're not building enough homes. That's why we're screaming about affordability with homes and an all-time record of about $420,000 for the average home in the United States. If we're going to have net outflow of immigration, that will alleviate that problem with household. But we have a net deficit of 3 million. It's going to take 2 to 5 years of similar types of immigration numbers in order to alleviate that problem. So households are not going to see, or renters that want to buy are not going to see relief in affordability for a while, but they might. And by the way, if we do, affordability is a nice way to say, you that own a home, your home's going to fall in price and you're not going to like it, but renters are going to like it. But you that own a home, when your home goes up in price and you say, oh, this is going to allow me to retire, renters aren't going to like it. So no matter what happens in the housing market, half the country is always unhappy. If the prices go up, the renters are unhappy. If the prices go down, the homeowners are unhappy. Right now, the prices have been going up because we've had a deficit of homes. And if that's going to be reversed because population growth is going to slow and the homes don't go away, then eventually prices will level off and maybe go down, and then homeowners won't like it either.
Okay, let's move on to talk about the Fed now. You tweeted.
Let's see his 30-minute candles real quick. Okay. Interesting, right? Palladium still going. Interesting. Same with platinum. Interesting. But is this thing going to tap the negative point of control or what? Or what?
This, or you made this post on X. This is an important adjustment in markets right now. Apparently, the prediction markets are pricing in that Kevin Warsh, not Kevin Hassett, will be the top nominee for the next Fed chair. We'll talk about this in just a second, but this is what Christopher Waller, Fed Governor Waller, had to say just today. Apparently, he said that we're close to zero job growth. Now, that's not a healthy labor market. I still think we're probably 50 to 100 basis points off of neutral. We're still got some room. We could bring things down. Prediction markets, going back to Kaushi, are pricing in a overwhelming majority of traders here are pricing in a no cut by January. Fed maintains rate, which might surprise some people, but maybe not yourself. What do you think? What's your view?
Well, a couple of things. That chart that I showed about the prediction markets was, as you point out, was 2 days old. That's changed a lot in the last 2 days.
Yes.
Yeah, because Kevin Warsh is the orange line. He's gone from 52% down to 20. Christopher Waller, who wasn't even on the chart at the time, is now up to about 25% chance. And
right now
trading around 50% or so. And the point I'm trying to bring up is this is a wide open race for Fed chairman. There is no real leader in the race right now. Christopher Waller is being interviewed the day we're recording by President Trump to be the Fed chairman. Now, keep in mind, a lot of Wall Street does these hawk-dove meters where they put the most hawkish member to the most dovish member, all 19 existing members. The most dovish member is Christopher Waller. Christopher Waller is an outlier. He is not near the center. He's not near, if there is a consensus on the Fed. He is an extreme case. He is uber dovish on the market. To his point about that we might have zero job growth and that's not a healthy market, I just got done saying it was. It is. You have to understand there's no job growth, Christopher Waller. And if there is no job growth, we don't need to create jobs. That's why the stock market and the bond market are not responding to the labor market, because they understand that. Now, to his point about it being 100 to 50 to 100 basis points, he's saying we need to go to 3% to 2.5% on the funds rate. The concern, I'll come back to what I said before. If you go to 2.5% on the funds rate and you're not addressing the jobs market, maybe because it doesn't need to be addressed, and you stimulate more inflation when the public is already seething mad about affordability, you have devastated this economy. It is a high risk move. to do something like that. I need better explanations from him about how many jobs we should be making and what he thinks about population growth. And he gave a speech in October about population growth, and he said it's all bunk. It doesn't matter. And it was mind-blowing to me that he said that, because it is the primary driver of how many jobs we need. Every economist says it, except for the one that wants to ingratiate himself to Trump to be the Fed chairman. There, I just said it. I'm worried about his motives, about why he's saying these things. And I'll be curious, if he doesn't get the job, where he's going to be in 6 months when he starts talking about Fed policy.
Probably dissenting. So,
Exactly.
well, let me pull up CPI once more. So this is from Cauchy. 2.8% is 25%, 2.9%, 34%. So traders are hovering between 2.8 to 3%, which is range bound next year. Now, what is your view on inflation? Let me just posit something to you, Jim. So Fed Chair Powell, and you can comment on this whether or not you agree with this, Fed Chair Powell straight up said at the last FOMC meeting that inflation was high because of tariffs. I'm paraphrasing somewhat, but he was pretty blunt about that. Now, let's suppose he's right, and I'll let you comment on whether or not he is right. If fiscal policy and trade policy were to blame for the higher inflation prints that we've been seeing, maybe going down to 2.5% of the Fed funds rate is not going to stimulate inflation because it doesn't matter. Maybe that's going to help with jobs and not make inflation worse. I'm just putting that out there. What do you think?
Yeah, so a couple of things. He did say that. The specific quote he said at the press conference a week ago was, if you remove tariffs from the inflation statistics, you're running it around the low twos on inflation. There is no statistic of inflation ex tariffs. So it's something that the Fed invented. Now, I say that not saying, I'm sure it's right. I'm sure that they've got some methodology that said that. I went back and looked at the statistics. I have no idea how they came up with that. So I'd like them to show their homework on this one, because what I see is the services inflation, which are largely not tariffs, is still running at around 3 to 3.4. I'm using CPI, somewhere in the low threes. It's coming down, but still in the low threes. And I see goods inflation going up, and that could be attributed to tariffs. But I don't see where he comes up with the idea that if you took tariffs out of the equation, we would be in the low twos. Like I said, he probably has a statistic, that shows that. I'd like to see how they invented that. But short of that, when I look at all the data that the CPI puts out, I can't come up with that. I still come up with a number that's in the high twos, the low threes. And I'll mention again, 6 years after COVID, 5 years after they said it was going to be transitory. We're still nowhere near their long-term target of 2%. They've been telling us for 4 years, don't worry, in 12 months we'll be there. 4 years they've been telling us that. 4 years we haven't made any progress towards getting to that. 4 years they've been telling us on their dot plot, don't worry, the inflation rate's elevated this year, it'll go down next year, and in 2 years it'll be at 2%. They've been saying that for 4 years, and it hasn't happened yet. And the reason I would argue it hasn't happened is, I'll make this simple. Every time we have a recession or financial crisis, and we had both in 2020, the economics landscape changes. It changed. COVID shutdown restart was one of the biggest economic events of our lifetime. I have actually argued it might be bigger than the financial crisis of 2008. It broke the 40-year decline in inflation. It broke the 40-year bull market in bonds. Those eras are over. We are now in an elevated inflation world. We have been for 5 years. I think we're going to continue to be in an elevated inflation world. And those that keep telling us that we're going to go back to 2% in a year or two have been wrong for 4 years. And I've been saying for 4 years, 2019 is not coming back. That is a different cycle. That is a different era. We're in the post-COVID economy, and the post-COVID economy has a much higher inflation rate.
Does that imply a much higher 10-year yield?
Yes, it does, because the 10-year yield is the chart you've got on the page. If you were to imagine a trend line on that chart, it is broken. We are going up. We have gone from 0 in August of 2020 to 5% by late 23 to the 4s right now. We've been consolidating a massive gain massive move up in interest rates. I think that over the next several years, interest rates are going to continue to trend higher because inflation, the primary driver, is not trending lower anymore. And as much as we want to stand on our head and talk about OER and talk about tariffs and try and explain it away for other things, then it's getting very hard, because I could flip the argument around. And I could flip the argument around. Let me go back. Gasoline prices have fallen 30%, and we still can't get the inflation rate under 3%. Gasoline prices are at a 4.5-year low nationally today, and we still can't get the inflation rate.
Wait, so you're talking about gas prices at the pump or crude oil?
Yes. The national average for gasoline prices at the pump is $2.91, according to AAA, as of this morning. The last time we were at $2.91 average was early 2021. And yet that alone, like I said earlier, if I told a bond trader, here's 2 pieces of information. Over the next 14 months, the Fed will cut 175 basis points and gas prices will go down over $1 or about 30%, fine. You can keep all the rest of your statistics. Buy bonds are going to rally. They didn't. They didn't because something else is overriding those two stories. And that something else, I think, is inflation. So what I would argue is you've got 3% inflation with a collapse in gas prices, and you still cannot get under 3%. Now, if gas prices go up, it's going to offset everything that that the Fed is arguing about tariffs and about OER and everything else. Gasoline prices, even though they're about 3 or 4%, they're enormously volatile, and they're a big, big driver of year-over-year or month-to-month inflation.
So if you are, I guess, long-term bearish on treasuries, long-dated treasuries, are you shifting then your stance to more risk on Bitcoin, for example? Are you bullish on Bitcoin then because of what we talked about?
No, Bitcoin's a different story altogether. But yes, I am long-term worried about the yields going up, and I think that they will. Now, they haven't for the last year or so, and I wouldn't be surprised if over the next several months they continue to trade sideways. But I think the next big move in yields is going to be higher, unless you tell me an exogenous event is going to come along and we're going to wake up one morning and go, okay, we just changed everything. Big red headline that says, that we're not going to sink into recession. You got to bet on something that hasn't happened that in order to, I think, to get a big rally in bonds. Otherwise, I think the trend is going to get up. As far as Bitcoin goes, Bitcoin, on a positive note, one of the things I've been very, very concerned about with crypto is that it's been highly correlated to risk-on stocks like the Mag 7 or the QQQs, or even the S&P 500. Well, we broke that. But for the crypto crowd, we broke that in the wrong way, right? Crypto's falling as stocks continue to move up. I would like to see crypto act as an independent asset. It is, but it's acting as an independent asset by falling. What do I think is going on is idiosyncratic to the crypto market. That's a fancy word for let me tell you what I think is happening. The crypto market, I've been arguing, made a strategic mistake. They saddled up to the administration, passed the Genius Act, want to get, more. They want the Clarity Act to pass. They want approval from the Federal Reserve, the U.S. Treasury, the federal government in order to be an accepted asset. And they hope to get adoption from, the TradFi, the traditional finance community, to buy it. That it was and is a mistake. Crypto is an alternative. It is a disruptor.
I mean, is it
It's
though?
supposed to be something different. Travis Kalanick, which was the
Like realistically, like a lot of this price action will not have happened without ETFs, right? Like a huge driver of flows to the upside. I don't know if that's necessarily a fair statement. Plus, like as the asset gets bigger, if you want it to continue to get bigger, you need institutional money, right? Because like the retail is not pushing this thing from like 2 trillion market cap to like 5 trillion. There's no money for that. So having a institutional / sovereign adoption like is part of the end game of this. If you do think it's going to be going higher.
Creator of Uber, when he had an opportunity early on to sell Uber out to Yellow or to Checker Taxi, why would I want to sell to them? I want to take their business away from them. Crypto should not be saying Jay Powell likes us, in that they've got a committee at the Fed, headed by Chris Waller, by the way, that is looking into crypto and been saying very nice things. The president loves us. He's issued a meme coin. We've passed the Genius Act. What they should be doing is saying, JP Morgan and the Fed is not my friend. I want to take their business away from them by creating an alternative. When they were arguing that, I think is when you saw the potential of crypto. This is what happens with it. It goes up a lot. It kind of loses its way, and then it has to right the ship. You are an alternative. You being crypto, you being Bitcoin, you are an alternative. You are not waiting for the Treasury or the president or the Fed's approval. You're going to build something different. And if they don't adapt to you, you will consume them, not allow them to consume you. That's what I think the problem is with crypto. They've lost their way. Now that they've struggled, their biggest argument was adoption. All the boomers are going to buy crypto. The ones that did feel like schmucks because it's down 6% and silver's up 120 and gold's up 70%. And I still see my crypto friends saying, oh, but Vanguard just in the last couple of weeks said that you can buy crypto on the platform. Morgan Stanley has now approved it for the wealth managers. I can imagine that conversation. Hey, Mr. Customer, you've got good news for you. You can now buy the worst performing asset that we have. We missed the 120% move on silver, but you definitely want to now buy a minus 6% year to date Bitcoin. That's not an argument that's going to work. I mean, I understand that there's contrarians that say, no, that's not the time to buy it. Well, were you selling it at 125 if you were a true contrarian? No, you weren't. So I think that they've lost their way. They want the adoption from the boomers, and the boomers are now looking at crypto as just another speculative asset, like gold, like silver, like Mag 7 stocks, like AI stocks, and they're saying, this one's the worst of the lot. Call me when it starts to right the ship. And this is the problem. If they were making an argument, we're building something different. We're building something unique. We're building the next financial system. Join us as we go into the next financial system. That would be a different argument. But they lost that argument by saying, we want the Genius Act, we want the Clarity Act, we want approval from the president, we want to be part of the system, we don't want to be something new.
There's also the conversation that large institutions
I don't know
like
if I agree
BlackRock,
with
at this time,
that.
Larry Fink and Rob Goldstein now, on how tokenization could transform finance. They want to tokenize billions of dollars, potentially even trillions the next 10 years of real world assets and securities onto the blockchain. That will necessitate people adopting Solana, XRP, so on and so forth. That's one argument. You don't buy it?
I buy that argument completely, that tokenization
Of course they
can
do.
transform finance. But Larry Fink's not going to do it. Larry Fink is not going to do it. This would be the same argument as Yellow and Checker are going to put together a ride-hailing app that's going to transform the way that you the way you get a taxi. They are incapable of doing it. It has to come from the outside. If you're going to allow Larry Fink to do this, it's not going to happen, because they're going to control it to make sure that BlackRock is a $12 trillion money manager on its way to $20 trillion money manager. They will control it. What he's arguing is crypto is going to destroy BlackRock's business, and I'm going to be there to do it. No, he's not. It's going to come from the outside. It cannot come from the inside. It will never come from the inside. All disruption comes from outside. And
That's not
mistake.
true,
So
right?
It's right. Tokenization can transform finance. But if you think that it's going to be Larry Fink and Jamie Dimon and the Federal Reserve and the Treasury Secretary architecting this transformative change, you're fooling yourself. They're just not going to do it. They're going to make platitudes that they're going to do it, but they're just going to control it in such a way that the old guard will never lose their position.
So just finishing off in Bitcoin and crypto. what
Like,
is the outlook for
obviously,
Bitcoin
but
and
they're
the
still
rest of
going to do it.
the crypto market? One, do you see Bitcoin dominance rising? And two, what is the adoption case, if any? What is the adoption narrative for the retail crowd at this moment? If we're not going to rely on Larry Fink and Jamie Dimon to help as on ramp into traditional finance, what then is the adoption narrative for the retail crowd?
So a couple of things. I think that I'm going to speak to the maxis right now, the Bitcoin maxis, and I'll be blunt. Stop shitting on Ethereum. They're your potential savior. You are saddling up to JP Morgan and the Federal Reserve by saying that they're making you legitimate so that you can get adoption. What you need to do is create the new financial system. You are a cornerstone with Bitcoin of the financial system. Ethereum has decentralized finance. And you can build that system that way to move forward with it. What happens with crypto is they do that. We're going to build, and then they lose their way because the speculative juices take over, and then they have a winter. We had one in 22. We had one in 21. We really, DeFi came into being in 2020, 2021. And then everybody got all so excited about DeFi that they were building before they even finished writing the code, and everything was getting hacked, and things were getting stolen, and things were getting a little bit out of hand. And then we had Terra Luna collapse. Then we had FTX collapse because we got too far ahead of ourselves. We went through a winter, and then we had another summer. So we're in a crypto winter right now. What's going to get us out of this winter is when the crypto crowd says, we have to start building again. We have to start building the new financial system, not waiting on bended knee for the Federal Reserve or the Treasury to bless us. We need to build a better mousetrap than they currently have right now. Then crypto will get out of this winter. Yes, I think that over the next several years, crypto has the potential to do that. Bitcoin has the potential to go to $1 million. But first, we got to get our minds right. And unfortunately, getting our minds right means some pain with lower prices to stop with this current argument that the president likes us, the Treasury Secretary likes us, and therefore we're going to wait for all of the boomers to call up their broker or go onto their online brokerage accounts with Vanguard and put 5% of their money into Bitcoin.
Like, the thing about this argument is, like, everyone that believes in Bitcoin right now already fucking owns it, right? So you need new buyers to come into the market, and he's saying that we should be excluding, that we should not be leaning on these people to do it. Like, who else is gonna do it then? Who else is gonna fucking do it? Like, the adoption has to come in some way or form.
Is over.
And there's also no going back, right? This whole thing he's talking about, there's no going back from this. So, like, unless this thing gets fucking wrecked by quantum computing and something new arises in its place, in which case I don't think people are going to be in a rush to go to digital assets after the largest, most popular one we had failed.
They're going to want to buy you because you're the next great thing. not because you've been blessed by the Treasury and the Federal Reserve. That's where I think we're going to have to go. And unfortunately, that winter is going to have to break us of that mentality and get us back to building and get us back to building a better mousetrap, get us back to a tokenization world that doesn't require Larry Fink to control it.
Okay, let's finish off in precious metals. You made a pretty good call on precious metals. Let's finish off here. You came on the show with me 2 months ago, early October, mid-October, right before silver hit 50. You said if it hits 50, it sustains that level. We're heading towards 70, 75. That's exactly what it's doing now. It hasn't hit 70 yet, hasn't hit 75, but your trajectory is spot on at 66.40. And let me just pull out and see, show you a longer term chart here. What does that chart look like to you?
That looks like a breakout. And that chart looks like something that I think over the next short term being the next, 3, 6, 12 months at most, because that's a 50-year chart we're looking at, is going to continue to go higher. Keep in mind that the precious metal markets are not very big. When you put them aside to the stock and bond markets, they're 3, 4, 5% the size. There's been tremendous buying for precious metals coming out of Asia. Asia is where all the buying has been taking place. The buying has not been coming from the United States, people on the Robinhood accounts, jumping on and buying silver. Yeah, there's been some degen buying that's been going on with that, but that's not the primary driver of it. It's Asia, and it's China in particular that is the primary driver. The Chinese economy is in deep trouble. I am a big China bear right now. I think that China it's not getting better, it's getting worse. I think that there's hundreds of millions of people in China that know this. They're trying to figure out how to protect themselves, and they're coming to the idea that precious metals is the way to protect themselves. Even the central bank is buying it because of their trade war with the United States. They want to try and de-emphasize the dollar, and they're buying more precious metals. That will continue, and these prices of gold and silver will continue to go higher, but it's all about what's happening in China. And right now, like I said, I don't see that changing, at least for maybe the next several months beyond that.
Okay, final question before we go. Your highest conviction bull or bear assets for 2026?
Interesting question.
Conviction. I'm going to answer the question a little differently, but along the same lines. I've been arguing we are in a 4, 5, 6 world right now. That cash will return you 4, bonds will return you 5, and stocks will roughly return you 6. Not this year or next year, but over the next several years. I say that for 2 reasons. One, we need to temper our expectations. We're used to this whole idea stocks go up 20% every year. They've done it for 3 years, well, almost 20% this year, but they've done it for nearly 3 years in a row right now. But also, 6% is not a bad return, especially if we're in a 3% inflation world. You're getting a real return on that. It's just, it sounds lousy because we're so
well, like the actual inflation is like higher than that, right?
Within the stock market, if you actually broke it out to AI stocks and non-AI stocks, the AI stocks are up about 27, 28% this year. And the non-AI stocks in the stock market are up about 8% this year, not far from my 6 as well. So my highest conviction is that get used to a 5% bond world, a 6% stock world. Maybe if you want to call AI stocks a different asset class, but the rest of the stock market around 6, that's not bad. It sounds bearish because everybody thinks that the stock market's supposed to double your money every 3 years because it's effectively what it's done over the last 3 years. That's an unrealistic expectation. So as far as my highest conviction, I would argue it's that you're going to continue to get those kind of returns. Also, keep in mind with the valuations in the stock market, if you're going to buy stocks and you think that stocks are going to continue to go up, you are going to need blowout massive earnings because you're paying so much for these stocks at a valuation level. And usually that's unrealistic right now. Other than that, if you're asking me my highest conviction call right now, it's probably what we were just talking about, is that the momentum trade in precious metals is going to stay so strong that they're going to continue to go higher.
Excellent. Thank you very much, Jim. Where can we find you?
Bianco Research is my research company. So it's biancoresearch.com, at Bianco Research on Twitter, X, at Bianco.
Interesting. Look at some of this dates, huh? These things are starting to go, yeah? Yeah, we are not. Pretty alarming, right? This whole like up right now was like all perp driven. Like spot is just selling off right now on Binance and Coinbase. Little alarming. Interesting.
Spend that money. Spend that money. Quiet hustle.
Looking a little sus, right? Looking a little sus. Boom, 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 boom. Because there's nothing to grab up here, right? Like this move was too fast for like liquidity to build up here. So the only like reasonable stop to the next reasonable stop to the upside is like this, right? And like a lot of these positions are still open down here, on top of like the higher time frame stuff. Boom, 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 boom. And the thing about the downside is starting to look suspicious, right? But yesterday, I think it was the 83 wall got put to 86. That's gone now, right? They took it out today. And one of the other ones at what 84 is it gone? And now there's like a gap from like 85. There's one wall left at 85, and the next one's 82, which is like below this cluster now. So looking more and more likely like this is going to be in the scope here pretty soon. Especially given the fact that we just came up to this negative point of control, tapped it, and just started reversing ever since. As these are starting to roll over as well. Try to get above the value area high, could not. So it'll be pretty interesting to see if we lose this zone, right? Not looking too hot, we'll say that. Oh, it's not looking too hot. Oh, we're testing his VWAP as well. It's pretty high, right? This move was like pretty yeah. Right, the 382, interesting.
Marcos. Whoa. Yeah. Ops talk, we let the charts talk back. Drill that math, boy.
Boom, boom, boom.
Used to sleep broke, now I dream in penthouse.
Shout out to the math. Shout out to the math. We'll get rid of this for now. Leave this like this. Also, a lot of the wheat stocks sold off today, right? I was looking at it earlier while we were watching one of those videos. Like they're the only things performing today. At one point, seems like all of them end up getting a sell-off. There's probably no news yet. Also, this is quite the move back down, right? Filled the gap immediately. Boom, 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 boom. Still holding up pretty well. Did our alarm go off? We have one up here.
Penthouse truth from the basement dreams. Now the floor got marble, the chart got beams. Marcos, the math made me rich. Talk less, print more.
Yeah. Actually. Boom, 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 boom. Let's see how we can read an EPUB on the desktop. Oh, it's so nice to not be sharing this monitor anymore. I can go back to like using my main monitor. Well, when you're on a computer all day, you know, right? If you're constantly on one monitor, that's not the main one. Fucks up your neck. Up your neck, boy. You know, interestingly enough, the spoofer has been back, right? Ever since the price has been suppressed again. It's definitely related to this somehow, right? The only time the spoofer was not on the order book was on the legs up. Which is interesting, pretty interesting. Boom, boom, boom. Got 30-minute candle closes. Dude, I swear today's been the funniest day, right? Seeing all these tweets, these people having like no clue about this price action. Fucking hilarious. Like, it's so like, isn't it incredibly obvious as people on Twitter can't trade? We talked about this exact scenario yesterday and all the reasons for it, all based on the data. And these people are all sitting here fucking like, look at this shit. Look at this shit. All kinds of stupid ass tweets like this all day today. The motherfuckers are like trying to come up with any narrative possible to try and explain price action because they don't know how to trade, right? They don't know what the data is. They can't interpret data. They don't even look at data. If they do, they can't interpret it properly, and they need to make up whatever narrative to like cope with the fact that they're shit trading. Don't know what's going on. Whenever I say that shit, I just laugh all day today. I've seen like 30 fucking tweets of people looking at this, just screenshotting this, go some crazy thing. Seems like a skill issue to me. Just a skill diff. We're sitting here talking about shorting this shit yesterday, fucking like 20 hours in advance. People are fucking lost. But what? Bum, 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 bum. What's all Intel doing? I've been wondering for a while if this gap's gonna get filled or what. Well, it's like an island too, funnily enough. Maybe it doesn't.
didn't believe, now they copy me. But math ain't something you fake on a beat. They gon' buy from me.
What's the stats on this?
They be keep tired from me. Like chasers, he tired to me. I don't know you late night running. D-Wop humming. Price kiss level got filled, no frontin'. Empty inbox, but the racks keep coming. Silk sheets now, but I came from nothing. Golden pocket tucked, I ain't need no light. TP here, why they still think twice? Small money steps, no dice, just math. I ain't post, I just watch them crash. Late night running, D-Wop humming. Price kiss level got filled, no frontin'. Empty inbox, but the racks keep coming. Silk sheets now, but I came from nothing. Golden pocket tucked, I ain't need no light.
Interesting. Boom, ba, 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 boom, boom. Go to the math.
They ain't believe it. Now the table long enough for all of us. Used to doubt me, now they eat too. Private chef plates in the beach view. Whole fam wrapped in the math I knew. Chart went up, now the sky ain't blue. Rose in the dry, mama got one. Bro got keys to a drop top run. Unc on a jet, he ain't never done coach. Said it's all luck, I just stuck to approach. Balcony glass where the sunset drip. Dreams got streamed, now the pockets flip. Didn't need clout, just a clean little fit. They laughed at the plan, now they calling it lit. Cousin in Dior wasn't like that before. Now he FaceTime daily, say teach me more. Granny in silk, no rent, just grace. She prayed for the trades and the wrist got laced. We made it through nights they ain't seen. Charts on the screen while they sleep. Now the winds feel deep, cause I brought the whole street.
We need to put something to this actually. We need to recategorize some of this stuff.
Used to doubt me, now they eat too. Private chef plates in the beach view. Whole fam wrapped in the math I knew. Chart went up, now the sky ain't blue. Rose in the drive, mama got one. Bro got keys to a drop top run. Unc on the jet, he ain't never done coach. Said it's all luck, I just stuck to approach. They laugh. Now they live in what I saw. The math was always enough. Marcos.
Time is it? 10:30.
Yeah. Marcos. Drop that data. CPI, drop on lit. Print the Rex Bugatti kit. Scrap folder, drop, I don't flinch. Long that wick, then flip that switch. Numbers flash, they panic sell. I just feel no wishing well. Slip that slip page, caught that spell. CPI blessed, now I rebel. I'm kinda misguessing, I'm pressing the button. Whip got modes like recession coming. They watching CNBC, I'm dumping. Caught that fake out, then I'm pumping. Inflation scared, we like that bait. Yo, I'll go slow, my math too great. 0.6 B, I open gates. 0.2 miss, I still get plates. Red to green, my net worth beam. Pre-CPI, I scheme. Size in dark, pool streams. Charts blow up like dream for real. CPI, drop on lit. Print the Rex Bugatti kit. Scrap folder, drop, I don't flinch. Long that wick, then flip that switch. Numbers flash, they panic sell. I just feel no wishing well. Slip that slip page, caught that spell. CPI blessed, now I rebel. CPI
We have GDX on here, right?
Fibonacci in the dark. Hit my 618 and embark. Gas, food, shelter, watch that print. They press short, I press mint. They post charts, I post tint. That Bugatti met no Lambo keys, they rattle loud. Economics got the crowd, but I just stare real unbowed. Cause I got edge, they not allowed. CPI, volatility divine. They pray for calm, I realign. Big tech move, I redefine. While they sweat news, I just recline. CPI, drop, I'm lit. Print the feel no wishing well. Slip that slip page, caught that spell. CPI bless, now I rebel. They wait for Jerome.
So
I wait for CPA.
look at some of this options data, a bit more in depth. Bum, ba-bum, ba-bum, bum, ba-bum, bum, bum.
Midnight grind, made diamonds out the drawdown. Now the charts look clean, and the wrist got frost now. Whispers turn loud, but I still move ghost town. Only thing I ever chased was math, not cloud. Late night running, VWAP humming. Price kiss level, got filled, no frontin'. Empty inbox, but the racks keep coming. Silk sheets now, but I came from nothing. Golden pocket tucked, I ain't need no light. TP hit, why they still think twice. Smart money steps, no dice, just math. I ain't post, I just watch them crash. Late night running, VWAP humming. Price kiss level, got filled, no frontin'. Empty inbox, but the racks keep coming. Silk sheets now, but I came from nothing. Golden pocket tucked, I ain't need no light. TP hit, why they still think twice. Smart money steps, no dice, just math. I ain't post, I just watch them crash. Backseat charts, coupe dash digital. Bins move silent, gains residual. Stared at the screen till my soul went critical. Now I sip slow with a view that's biblical. No sleep, just plans and feels. Back test deep like I'm hunting for kills. Wrote the script, they follow the thrill. Thought I printed that map, let them chase the hills. Vested in zones they don't even see. Dash line bounce, that's prophecy. Didn't believe, now they copy me. But that ain't something you fake gonna be. Late night running, VWAP humming. Price kiss level, got filled, no frontin'. Empty inbox, but the racks keep coming. Silk sheets now, but I came from nothing. Golden pocket tuck, I ain't need no light. TP hit, why they still think twice. Smart money steps, no dice, just math. I ain't post, I just watch them crash. Late night running.
I didn't even realize earlier this thing fucking hit it. Interesting. They couldn't even see that. Goddamn.
Snatcher, price bounce pixel on the matcher. They chase green, I stagger. Fade the move, no swagger. Flash that wick, then vanish. Got that, now they panic. No luck, just a static. That math hit, automatic. Wick, tapper, stop, snatcher. Price bounce pixel on the matcher. They chase green, I stagger. Fade the move, no swagger. Flash that wick, then vanish. Got that, now they panic. No luck, just a static. That math hit, automatic.
Bum, 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 bum. I'm already hungry again. Goddamn. Goddamn. All this cardio. It ramps up your appetite. We gotta do a juice box here pretty soon. So I want to go to bed early. I want to be like a wide-eyed awake and early in the morning tomorrow. I got CPI is 8:30 and unemployment claims, and the European Central Bank talks like 15 minutes afterwards. Bum, 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 bum. Also, what was that announcement supposed to be? Wasn't there some kind of like Trump announcement today? a nothing burger basically.
PPI just dropped. We trade that math, Rex, ice. PPI pop, count up Rex. Math too strong, I ain't fall for the trap. Go AP, got a face all black. Gotta hit clean, made the wrist go crack. Richard Mill tick when the spike retract. Chart went red, now the coupe all matte. Stats don't lie, got the haters all flat. Made one move, now I'm up like that. Hopped in the market like who won't smoke. They long that wick, I broke they hope. Back this deep scene where it poke. Then drop that size, that precision cloak. Wrist game look like a data stream. PPI 5 got me sipping lean. Told my jeweler chart that gleam. Stats on lock, I just print the dream. PPI pump, count up racks. Math too real, I don't trust no yak. Two-tone rollie, the best mismatch. Price went dumb, I let that pass. Chart went ghost, then I fade like flash. Big boy feels no need to bash. Candle wick low, then I let that slash. Ops got clapped off a retail stash. Micro move, but the payout large. Price that hit, now swipe that charge. Bag that face look like a chart. All on PP, I play my part. Math too icy, flows too cold. PPI hit, then I went gold. Bought new yacht off a mean threshold. Blue face day, never get sold. I ain't need no luck, just stats and time. PPI whispered, I caught that sign. Haters loud, but they laid on. I just let my trays align. PPI pump, count up racks. Math too strong, I ain't fall for the trap. Go AP, got a face all black. Gotta hit the wrist go crack.
I'm just scrolling through Twitter right now, and every like 10 tweets I see someone bitching about this morning. I can't, man. There's something more productive than this shit right now. I don't miss anything important, but it's not right. It's not to do that. Yeah, how do this thing do? Quite the drop on earnings. Boom, boom. And most of the gaps are filled, but there's still this one, right? Quite the big gap down here. Also like confluences towards like the Max Payne. Interesting, right? Was a pretty interesting chart we saw today. Where was it? I think it was like the short bear tweeted it. We gotta go back on the toy, right? Yeah. Look at this shit. Whoops. Whoops. A little alarming, right? Retail and managers near max long allocations. Little sauce, little sauce. Might need a little bit of a shakeout.
FOMC, that's just advanced. Jerome speak loud, I whisper back. Caught that spike, then flip the stack. Balance sheet look wild on track, but I got feels, no time for they lean on Jerome, I wait on my zone. He pressed that mic, I press that phone. POC tagged, I'm in my throne. Rate go up, I'm still full grown. Hello dash hit pixel snipe. Cut a hike, I trade that hype. Dubs are hawks, they sweat all night, but I just fade, the math too right. Liquidity sweep then breaks. Fade that wick, I clean that plate. 2-point move off FOMC, but I was there pre-debate. Macro flow, no tweets, just big size and order sheets.
How long it's been?
I talk cheat codes, market move slow, I beat those. Smart money view my craft.
Damn.
Just math. Marco's chart got gold lines, and Fed days make them all laugh. Move the mic, but we move size. He talk hikes, we talk fills. They chase candles, we chase bills. This ain't no hype, this real skill. They wait on Jerome, I wait on my zone. He pressed that mic, I press that phone. POC tagged, I'm in my throne. Rate go up, I'm still full grown. Yellow dash.
Yeah, damn.
I trade that hype. Those are hawks, they sweat all night, but I just fade. The math too.
We have to download Caliber to read this thing, apparently. Don't they already have that? I swear I already have this. Yeah, I do. Can I post this in the Discord? Or not? Or not? Too big? Are you fucking kidding me? Fuck! How big is this? Is that right? Still too big? Oh, hell no. Hell no! Yeah, because that algorithm I was testing the other day, I think we found a couple edge cases where that thing is not ideal. But the problem is if I like code in specific rules to avoid them, it might fuck with some of the like that typical entries that do work. So I think this one might be a little bit of a dud. Because at the end of the day, we don't need to have like any more algorithms trading. It's fine as is. But I'm trying out new ideas, right? Especially for the situation where like someday these things like stop working properly. Or maybe we just find something a bit more efficient. Probably gonna be when I set most of the Christmas break on, to be honest. That and like here's the thing, like we did like a massive options nerd out back in the day to like understand how they all work, so it could like interpret the data correctly in terms of like what's going on in the options market. We never like actually traded options. So the plan is to do a little bit more of a nerd out, and then next year have like one or two, like basically like the video from yesterday, right? Like the elite options trader guy. Have a couple of trades like that in mind to like leverage them, or like take advantage of the leverage they provide. Also, I saw a video by like Lance Brightstein on like a pretty interesting way to use them to like hedge certain swing trades in the traditional market. And also an interesting way to use them near expiry to leverage trades, like hedge your downside. We got a pretty big to-do list growing here. Interesting. It's supposed to be a 4-hour candle. They're about to do a juice box to get out of here. Trying to get this textbook on my desktop. Be a lot easier to read than having to sit here looking at my laptop the whole time. Can I mail it, perhaps? Perhaps. We have so many books to read too, man. Fuck. Fuck, there's not enough time in the day, goddamn. Like a backlog of books. Fuck. Fuck. Blazing. Well, let's be honest, it's not going to be a particularly interesting juice box, right? Not going to be a particularly interesting one. If you weren't here yesterday, you kind of missed out at this point. Might have to sit on your hands a little bit. Let's see if this thing worked.
Twist, that's jet fuel fumes in the chart, do flips when I enter the room. Wick that candle, don't flinch, just fade it. They trade off hope, I'm calculated. Zone like turf, and I just invaded. Ops got hit, and they chart deflated. No mask on, I do a bare face. With a richer milli on the wrist, no brace. Slide through stealth, but I leave no trace. All I left was a trap in a big briefcase. Stepping on they zone, they ain't pop out. Hit they stops, not a green, just top out. Chart smoked out, lungs full of loud. We sipping that walk while they margin drown. Zone got marked, I spun back twice. One little wick, then I ended their life. I don't tweet threats, I just pull up right with the size so fat it distort they sight. They don't want smoke, they just want clout. They drawing boxes, I'm taking them out. Zone looks soft, so I walk on in. Snatch they stops with a savage grin. Gotta crawl through the digital tape. They candle jump, that's my favorite bait. They try to break out, I bring the weight. Flip they longs, now I'm eating off plates. Math in motion, no luck, no hope. They was dreaming green, I handed the rope. Ice in my chain, match the fib.
What the hell is this? What the fuck is this? Oh, I see. I did the wrong thing. Oh, come on. Okay, not bad. I guess you it's somewhat readable. To be honest, it's way better on the MacBook than this. I might have pick up my MacBook this monitor. I have the cable here somewhere, right? I put that there. Gotta be around here somewhere. Not ideal. Okay, we'll do this later. Let's see how this 4-hour candle closed. Boom, boom, boom. Okay. Not really much to talk about in terms of a juice box though, right? We'll say that. Close this. Close this. Lower this a little bit. Okay. Potential longs. Really not much going on, right? At this point, it's really not much going on. You kind of missed, you certainly missed the ideal short opportunity earlier. And like the red box we had yesterday with the high leverage liquidations, like if you were trying to get filled on this, like you would have got this, right? At least like some of your orders would have started to get filled. And the problem is, like, in terms of like this stuff, you kind of already missed it as well, right? If you're gonna take like the initial pullback, like ding 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 at the end of the line. Plus, like the obviously like the new day had not started, but if you like you can track the developing. It's called like the deval, right? Like developing value area low. It was a cure, so like this thing would have been the opportunity to chase it perhaps. Now a little late. Because there is not really much going on here in terms of liquidity on the low time frame, but there is like a little cluster right here to 382, which is also where yesterday's like VWAP is right now. Like maybe you can entertain like a short like this. Or it's gonna be like at the value area high up here, right? Like something where all these VWAPs are confluencing. And the long is gonna be like flipping the zone at this point because like now like the risk reward. Like suppose you entered like right now on this candle close. Like, what are you gonna do? Like put your stop like right here below the VWAP and like this is your target. with like this is your trade essentially. It's not really a trade, right? Boom, 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 boom. Yeah, probably your best bet. In terms of this, we did end up filling the gap down here, so there's that. Hard to say, because right now this move up is like, oh, it's just all perps making this move, right? Spots just like selling off or like it's kind of tailing into like the flat zone right now. Maybe it starts to pick up over the night. In reality, the next like high quality short opportunities are going to be like finishing the zone up here or the higher level. And the long is like, if anything, it's going to be finishing this, sweeping this garbage. Which you might not get, right? You might not get. We kind of talked about how like this could be the low the other day. And like so far, they're still trying to defend it. But there is like a lot of like liquidity still left down here on these like 2 wicks. And then obviously this target. And we were talking earlier, I think it was when we finished the video with that Blanco guy. Essentially, like the order book situation has changed a little bit down here, which is that kind of made this spot a lot more vulnerable. A lot more realistic for us to come tag these lows now. At least in its current state. Start writing some of this stuff down. What did say? Finish sweeping the high leverage lows at like 85k basically. And then 2, it's like going to be flipping the PD value high. Third is like what? Everything else, right? All the previous plans that we've been discussing for quite some time now. Essentially all of our higher time frame plans. Our time frame plans have every juice box for like a fucking month has had this written, right? And for the shorts, the stuff we were just talking about, it's like 382 VWAP, like 382 plus like PD VWAP plus liquidity grab. Or like this like golden pocket PD value high. And other than that, same story in terms of the shorts, right? The higher time frame plans haven't changed. Hard to say though right now, hard to say, because like we just grabbed a bunch of liquidity on both sides basically, right? Kind of a bit of a whipsaw here. And we have CPI tomorrow. Tomorrow's a lot of news events in the morning, so kind of like where we go from here is a little sus, especially given how low volume things are right now. Yeah, because we also have like I mean, there's a lot going on tomorrow, right? The UK is like announcing their policy rate. Same with like the main financing rate in Europe. Then we got CPI and unemployment. And we have a new print on the manufacturing index. Then we have the European Central Bank talking right after. And then storage news on natural gas, which is maybe not the biggest in news, but given the situation in Venezuela, could like impact the energy sector a bit. And then there's the Bank of Japan stuff, which I'm not sure if it's going to be like a huge deal or not. Because it seems seems almost certain they're raising it, right? And it's kind of been known for a while. Yeah. So yeah, we'll see. Most likely, I'd probably just chill and wait for one of these juicier trades to set up. But I'd also be a little careful, right? Because whatever, as always with the juice box, right? They're just ideas to get the juices flowing, make sure the data's aligning when we get there. But there's a world where we start to get to these levels, because at this point we're basically breaking down, right? Just this whole thing. We essentially be breaking down. So I don't know if I'd be too confident on taking this if I'm not seeing like a lot of confluence in terms of the data. Also depends what these guys are doing. And then same with the upside, right? Like if we start to finally break this level, we might end up with squeezing towards this higher stuff. Just keep that in mind. Keep that in mind. Don't get too crazy. Are we missing anything? Not really, right? We've kind of been talking about everything else for quite some time the past few days. The whole options expiry situation, yada yada yada. I think that should do it. Maybe we forgot something in here, but whatever. Not a big deal. We are gonna call it a night. Kind of do a quick chat shout and get going because boy, I'm tired and I'm hungry. Goddamn. Pretty short one today, right? Shout out to Harris Kamal. Shout out to Olympic. Yeah, we'll be back tomorrow, usual time, same shit. Mine doesn't stop. Until then, I'm out of here later. Later.